Chapter 7. Confidence. Confidence is a feeling which reflects the coherence of information and the cognitive ease of processing it. Daniel Kahneman, Thinking Fast and Slow. Right now, there are new traders out there who feel more confident than 20-year veterans. How can this be? The gap in skill between them is immense, and if we were to bet on who was going to make more money in a year, you'd only take the new trader if you were looking to gamble. Their levels of confidence and skill are not aligned. For many of you, the confidence you have in your trading is not an accurate measure of your competence as a trader. If it were, you wouldn't get caught up in a rush of euphoria after closing out a huge trade and then make questionable bets thinking you can't lose. You also wouldn't lose conviction for trades that you're normally certain about during a drawdown. But confidence is an emotion, and just like the other emotions described in this book, it's vulnerable to the influence of flaws and biases. You make decisions based on how confident you feel. When feeling strong, you size up, take on more risk, and trade more. Of course, if you're overconfident, those actions are problematic. Low on confidence, and you're likely to hesitate, cut down on size, lean towards consensus, and look for a new system. For those of you skeptical of the role of confidence in performance, I agree that it has been oversold as something that you need to have to be successful. That's not the case. There's no causal connection between confidence and how much money you'll make. You don't need to feel confident to be a profitable trader. Being confident that you can make money doesn't mean you will, just as lacking confidence doesn't mean you won't. You need to be competent as a trader more than you need to be confident. Regardless of how you feel about your ability, after a large enough sample, your results tell the real story. But confidence does help you navigate the short term, when you don't exactly know what your skills are capable of producing. And having confidence helps you to perform at higher levels compared to when you're lacking it. Confidence is like the oil in an engine that allows the parts to move with less friction. It allows you to make the most of your skills and knowledge as a trader. Just like the oil in a car, however, too much or too little causes problems. You need the right amount to operate at peak efficiency. Many of you will come to this chapter as you come to me for coaching, when your engine is seizing and your confidence is stalled. There's a natural tendency to focus on correcting a lack of confidence when having too much of it could be a bigger problem. Let's look at both more closely. In today's day and age, it might sound strange to suggest too much confidence is a problem, particularly in Western society where confidence has been anointed as the be-all and end-all. The idea that you could have too much of it doesn't jive with that perspective. Remember, however, that confidence is an emotion, and when emotions rise too high, because you're excited, greedy, or euphoric, higher brain functions decrease and mistakes are made. Being overconfident doesn't mean that you're outwardly arrogant, cocky, or a greedy blowhard. Many traders are plagued by overconfidence, but exhibit only subtle signs of it. When there's a feeling of certainty about market direction, especially without having done a complete analysis, that's overconfidence. When you get amped up about how you figured out the market and are going to make a killing, that's overconfidence. It can also manifest as a refusal to admit mistakes or an insistence on being right. On a winning streak, you take trades just for the sake of it, or you don't think leveraging a position means you're adding risk. You cut corners and avoid pre- and post-market routines. Or you may be discounting the role of variance, assuming that if you timed a trade perfectly to make the maximum, it was all you and not luck. From a performance standpoint, being overconfident means that you're overestimating your real competence. Basically, you're operating more in a bubble relative to what's real. On some level, every trader needs a little bit of that. In the short term, you can't precisely know what your edge is, and there's arguably more upside than downside to having a small amount of overconfidence. For example, having an extra bit of confidence helps you execute your strategy in the face of uncertainty, learn from mistakes, and adjust to changes in the market faster. On the other side of the coin, when you lack confidence, it can be easy to say, "I'm not feeling it," and avoid trades you normally take easily. Maybe you start feeling less confident than usual, and slowly it becomes a bigger trend. You're more consistently down, unsure, depressed, or whatever the traits are that you associate with somebody who isn't confident. At a certain point, these traits begin to feel bigger and all-encompassing. You might wonder if there's something wrong with you, or that maybe you're just not cut out for trading. Suddenly it's all doom and gloom. You're stuck and can't get out of it. Or you might end up denying it's a problem, and do whatever you can to minimize the idea that you could have a confidence problem. But there's a far more practical way of thinking about it, which is that confidence, as it relates to trading performance, has many dimensions. Think of it more like pieces to a puzzle, rather than a singular thing you either have or don't. In my experience, it's far more common that a couple flawed, incomplete, or missing pieces create a weakness in confidence than for the entire puzzle to be missing. You simply need to isolate each weakness and correct it, much like we've addressed every other issue in the book. In surgical fashion, find the flaw, fix the flaw, and confidence is restored. While some traders tend to struggle with either overconfidence or low confidence, others go through big ups and downs with both. This especially happens when your confidence is based primarily on results. You end up riding the highs and lows of winning and losing like a roller coaster. You become more obsessed about the intraday up and down ticks of your P&L, and your confidence goes along for the ride. The more you make, the more your confidence rises, and the more likely you are to become overconfident. Execution begins to degrade without you realizing it. Variance continues to be on your side, so small mistakes or subtle drops in execution don't get punished. Part of you feels like you're just going to keep making money, and you get so caught up in riding the high that you don't see losses coming. When results suddenly take a nosedive, it's like getting the carpet yanked out from underneath you, and you're face first on the ground with your confidence flattened. You try to talk yourself through it and stay positive. You show up the next day, optimistic and ready to execute. But losing again is deflating, causing you to question what you're doing. The way you can stop these emotional swings from being so dramatic is to develop what I call stable confidence, which means that your confidence is based on something more solid and independent than just results. Stable confidence happens when your perspective is untainted by the flaws that cause instability. You become automatically better able to withstand the chaos of the markets, variance, and things out of your control, so you can adjust your strategy more quickly and accurately. It's like you're anchored to something solid enough to withstand a tornado. Stable confidence enables you to focus much more on your execution than on P&L in the short term. Of course, profitability matters a lot, but emphasizing execution in the short term is how you make more money, or lose less, and learn faster. Nature of confidence. Confidence is the foundation of your mental game because it's the emotion that directly reflects your skill as a trader. Viewing confidence as an emotion may be a novel idea when it seems like something solid that you either have or don't. But think about how you and other traders talk about it. You'll often use the word feel, like I'm feeling confident or I'm not feeling it. Skill is solid and much harder to change. Confidence is fluid and can change in a flash, just like other emotions can. Confidence problems develop as a result of beliefs, flaws, biases, wishes, and illusions that alter your perspective on your skill. That's what the bulk of this chapter will focus on. But first, it's important to highlight that a drop in confidence can be a signal that something is off in any of your individual trading skills. Other, more ancillary skills can also be off. These might include studying or researching, networking and collaborating, and the mental side of being a trader, which includes skills like focus, discipline, work ethic, and emotional control. More experienced traders should first analyze a drop in confidence as a signal of a drop in skill. Maybe you're in a slump and out of sync with the market. The game has changed, but you haven't caught up yet. Or maybe your confidence is down because your ability to execute your strategy is inconsistent. Despite your best efforts, you continue to take marginal trades because you lack the necessary discipline or nuanced skill to navigate discretionary trades. Either way, the drop in confidence is not the problem. It's signaling the real problem to be addressed. When you lose confidence like this, it can easily be misinterpreted as something mental, when the solution will actually come from the technical side of the equation. The drop in confidence is deserved because something is off skill-wise. You just haven't identified it yet. It's better to lose a little confidence, however, than to be overconfident and blindly continue as though nothing was wrong. That's how problems become magnified. The key is not overreacting to the signal by becoming pessimistic or negative and losing more confidence. Traders with stable confidence can remain objective in this spot, knowing they'll eventually figure it out. On the flip side, a surge of confidence can reflect an expansion of your skill set and reaching higher levels of competency. Something has clicked. It almost feels like you're cheating. Your hard work has allowed you to see these trades so clearly that you can't believe it was so hard to see before. From a practical standpoint, this increase in confidence is confirmation that the front end of your inchworm is expanding. But watch out, as this can easily turn into overconfidence when you assume that you've figured it out and you believe that you'll continue to make more money now, or that your future goals are assured. Take the rise in confidence as confirmation that your work is paying off and continue your efforts. Don't use it as evidence that you can passively ride the wave, or you'll eventually get into trouble. Common signs of overconfidence. Being overconfident is like having your head in the clouds while thinking you're on solid ground. I imagine it like a cartoon character who unknowingly runs off a cliff and is suspended in midair until realizing what's wrong. When you become overconfident, you don't realize that your perception, analysis, and execution have begun to degrade. As they degrade, you become looser with your risk management parameters. Your focus and energy on finding the next idea or adapting your system decreases, and you start to justify getting into a marginal trade. You become more complacent in your decision-making process and put on weaker trade ideas that lack the usual rigor. Overconfidence is often fueled by a big swing in profitability. Perhaps you've had some outsized returns, like your biggest win or your biggest month ever. It can also show up when you start to feel like your understanding of the market or your development as a trader is really clicking. You can overestimate the extent of what you know and start to feel certain about market direction. You become more stubborn and can't admit a mistake, take a loss, or accept advice from more seasoned traders. You assume losses are temporary and that you'll continue to print money. You get overly excited about a trade, and at the height of this euphoria think, "This is going to make me rich," or "I figured out the market." For some of you, your head will inflate so much that your sense of superiority will make you criticize other traders or the market as a whole, saying things like, "People don't know what the hell they're doing." When you're expecting to make money, it doesn't make much sense to bring the usual focus and energy. You spend less time in front of the charts, or even if you're there, you lack the vigilance compared to your optimal state. Overconfidence can pump you full of adrenaline and make you feel on top of the world, and on the flip side, lead to complacency and taking it easy. As I said in the intro of this chapter, traders experience overconfidence in a wide variety of ways. If you're not showing this emotion outwardly in a big, dramatic way, then you may assume that you're not overconfident. But overconfidence can show up in understated ways too, such as when you are overly convicted on a particular trade, refuse to take profit at your target because you assume you'll make more, are eager to trade but less rigorous in your preparation and execution, quickly make decisions because you feel like you can't lose, justify more risk by saying, "This has to go up," want to always have action regardless of the risk, neglect valuable signals and only focus on a few pieces to make a buy or sell decision, impulsively enter or exit trades. Subtle signs of overconfidence were the reason Brendan, a commodities and futures trader from Canada, hadn't solved his problems executing a morning strategy, which resulted in a lower win rate than his afternoon strategy. He would become certain a trade was going in his favor and think, 100%, I can't possibly be wrong here. Then the trade would blow out, but his excess conviction wouldn't allow him to exit. He couldn't admit that he was wrong. This led to big losses, sometimes up to 30% of his account, as well as to revenge trade. Intent on ending every day green, Brendan would force trades and instead too often hit his daily stop loss. This was particularly painful because easier trades would pop up 20 minutes later and he couldn't take them. Brendan also struggled to take profit at his target. Logically, he knew a fight for the absolute top wasn't worth the risk, but a desire for perfection compelled him to fight for every cent. Then after a pullback, swirling thoughts about how much he lost would cause him to start looking for trades rather than letting the trades come to him. The last sign of overconfidence, and to Brendan the most surprising, was in his goal setting. If he made $10,000 in a month, his goal for the following month wasn't to make 10% or 20% more. No, Brendan would look to make $100,000. He didn't realize how much pressure he was putting on himself with this big of an increase. It made him do things like break the rules he'd set for how many trades he could take in the morning. His big goals were setting him up for failure, and he was spinning in circles due to the large drawdowns. When I lay the examples out one after the other like this, it may make these signs of overconfidence seem obvious, but in the midst of the daily grind, they weren't obvious to Brendan. Not until he started digging into these problems did his outsized conviction, desire for perfection, and unrealistic goals become clear. At the heart of all of them, we found two main flaws: believing he could be right on every trade and expecting perfection. Brendan was able to resolve these problems by using the advice in this chapter and the real-time strategy I discuss in Chapter 9. He discovered that he never gave himself credit for any of his successes. The advice that I've included in the perfectionism section was particularly helpful to Brendan, helping him steadily build the muscle, so to speak, of recognizing that he knew what he was doing and was profitable. While it took some time for the new perspective to become second nature, He had the data to see that over a large sample, he's winning at 60%. Now when Brendan takes a loss, he just thinks, this trade is one of the 40%. I'm still playing my game, and in the long run, I make money because I'm following my strategy. At this point, Brendan is much more consistent, both emotionally and in how he trades. He can take losses easily, doesn't force trades, and is able to stay out of harm's way, as he explained it. He's able to immediately get back to watching the market for great opportunities he couldn't capitalize on before. Similarly, the corrections to his desire for perfection allowed him to take profit at his target and accept just catching the meat of the move, not the entire thing. His new perspective allowed him to use the logic that perfectionism had hijacked, that 1 cent is insignificant and not worth the risk to chase it. Taken together, these improvements have made a significant impact on Brendan's bottom line. His win rate has stayed the same, but the big losses that caused carnage to his P&L and emotions are gone, and as a result, his P&L is steadily climbing. Common signs of lack of confidence. Lacking confidence is like getting a car stuck in the mud. Sometimes with a little effort and luck, you can get out quickly. Other times, the more you struggle, the deeper you sink, and the more desperate you become. That's when you floor it looking for a quick escape and end up digging yourself into a deeper hole. Confidence can get stuck like this as a result of some big losses, a sustained drawdown, seeing others making a lot of money while you're not, or continually missing opportunities. Suddenly it seems like nothing you try works. You get creative, lose more. You try to figure out what's not going well, but you can't come up with an answer. That leads to more doubt and more instability. You force, lose more. You become negative, thinking things like, I suck at this. I can't come up with a single winner. I just keep losing. You take the rest of the day off, but when you see the juicy trades you missed, you lose even more confidence, now related to a weakness in your emotional control or mental game. You don't know why you struggle so much with it, and you assume that no one else does. You question whether you're as good a trader as you thought, and wonder, if I missed a big move like that, how could I be any good? If you're not any good, then what? You can't quit. You've invested too much time. But this is as far as you've gotten. Was it for nothing? Will you fail? For some, this description will hit home. For others, it's too severe. Obviously, there's a lot of variation in what traders are like when they lose confidence. Here are some additional descriptions of what you might be going through. Overly focused on P&L, account balance, or the size of a drawdown in an unproductive way. Uninterested and making excuses not to trade or find opportunities. Wondering if your strategy has stopped working. Difficulty finding new ideas, and unable to trust that what you do come up with will work. Embarrassed and comparing yourself to other traders who are doing better. Beating yourself up for not having what it takes. Thinking you've lost it and can no longer perform up to your prior standard. Discouraged that you're not making progress. Depressed or down about your performance. Feeling like previous success means nothing. Desperately jumping from system to system, looking for something that will work and make money, as if you're looking for the answer to your poor results. While some of these signs you will recognize easily, others are less obvious. The following scenarios are examples you may not immediately associate with having a lack of confidence. Trying to hit home runs. A hidden signal of a lack of confidence is taking an extreme setup that can have a big return, aka trying to hit a home run. Taking a trade like this can arise from a lack of trust, belief, or confidence in your strategy and your ability to consistently create profit. You're looking for a windfall to give you confidence that what you're doing is right. But a trade like this is outside your system. It's akin to gambling. Even if it pays off, you're not getting the right confirmation about your skill set, and you're actually in a weaker position going forward. Sure, at that moment you have more money in your account, but you got lucky, and you know it. That weakens confidence, and when you inevitably lose confidence again, you're more likely to look for a similar type trade. Next time you might not get so lucky. The attempt to force a home run type trade is a subconscious attempt to make up for prior losses and escape negative thoughts about your trading. A big win means you must be good and would eviscerate any doubts to the contrary. That's not something you're thinking about consciously when you attempt a trade like this, but often traders have a hard time understanding why they take them. On the outside, it looks greedy, and others around you may accuse you of that. But it's important to analyze the problem cleanly. If you have a cluster of other signs that show you're actually struggling with a lack of confidence, look closely at what the real intent of taking a trade like this is. It's likely that you're looking to win a lot of confidence quickly. Quick tip. When you're feeling low in confidence is not the time to overhaul your strategy, because you're unlikely to do so correctly. Put extra emphasis on executing your existing strategy. You know it can make money, and you'll be able to start rebuilding your confidence in a more sustainable long-term way. As you start to get back on solid ground again, that's when you can take a look at what you've learned recently and adjust your strategy. Lack of confidence can pull you out of the zone. When you become aware of how incredibly well you're doing, that awareness is a signal that your confidence hasn't grown large enough to support the idea that you could be this good. Your skills and confidence do not match. You're surprised by how much money you've made, the year you've had, the feedback you're getting from other traders, or your own uncanny sense of the market. Your perspective on your own competence is artificially low. This often shows up in traders who struggle after going on a heater or who have the best month of their career. If your confidence was in line with your skills, you wouldn't be surprised by what you accomplished or by what you were able to sense about the market. You don't get surprised by the things that fall in line with what you expect of yourself. You're only surprised by the truly unexpected. If someone rings your doorbell and it's your neighbor, you're not surprised. You may wonder what they want, but it's not out of the realm of possibility for your neighbor to ring your doorbell. If, on the other hand, you answered your door and it was the President of the United States, that would be surprising. If you're truly surprised at your performance, you don't yet believe that you could actually be that good. Quick tip. If you want to build a bigger pyramid, you need to build a bigger base. When you become surprised at how good you're performing or how good you've become, don't try to force your intuition or do anything crazy. Return to your B game and make your base wider by removing technical and mental errors from your C game. Stable confidence. In a sense, you can consider stable confidence as the middle ground between overconfidence and lacking confidence. That doesn't mean you feel neutral, robotic, or numb. In fact, it's quite the opposite. You're full of emotion, but that emotion more accurately reflects your real skill, not misperceptions caused by flaws, biases, or short-term results. Having stable confidence means that your confidence never swings to extremes because of variance, or for any other reason. Of course, minor fluctuations occur, since growth and variation in your performance is constant. But there is a degree of solidness that remains. The major flaws, habits, or biases have been corrected. As a result, you're more easily able to perform at a high level, evaluate your strengths and weaknesses, maintain a clear mind even during periods of market chaos, access and trust your intuition, avoid big mistakes, adapt to changes in the market, focus on finding opportunities and executing, focus only on what's most relevant without getting distracted. Since your level of confidence influences execution, development of trade ideas, adjustments in your strategy, sense of the market, and other decisions around trading, it's important to have your confidence be as stable as possible. For obvious reasons, the goal of this chapter is to help you to build stable confidence. As you resolve the flaws and biases you have about your trading skill, you'll get there automatically. Take David, a retired actor who's been trading bonds, futures, and options part-time for the past 6 years with the intent of making it a full-time gig. When he and I first started our sessions, he was not yet profitable, and confidence issues were part of the problem. Flashes of entitlement and overconfidence would strike when he was doing well. Market movement seemed so easy to understand that he would size up too large and overtrade. On the flip side, when he was losing, confidence would go way down, and thoughts like, "I have no reason to believe that my strategy will ever work again," would lead him to jump to another methodology he thought would be better suited for that market. There was a distrust both in himself and those he was trying to learn from. For the past few years, David had a grass is always greener state of mind, and he leapfrogged from one strategy or instrument to another, based on small samples of data or erratic market conditions. Driven by a life lesson that there was always a better way, he would quickly lose faith in a methodology, even before getting a big enough sample to properly evaluate it. Through our work, he realized that he had to commit to a strategy and focus more on implementation and understanding his rules under changing market conditions. By sticking with it and gathering a larger data sample, he found the limits of his knowledge and owned up to his shortcomings instead of jumping ship, all of which led to greater stability in his confidence. Reducing the loss of confidence was the first step. After that, we needed to tackle the overconfidence. The flaw driving this surge in confidence was essentially the polar opposite to the flaw lowering his confidence. He felt that he had found the strategy that would dump money in his backyard forever, Saying this out loud helped, but he needed a little something more. After getting to know David, I suggested he create a poster that detailed all aspects of his overconfidence. David took that idea to the next level, actually hiring an artist to draw a cartoon caricature of him, with details listed from his confidence profile to reference during the trading session. Then whenever he would start to become that cartoon version of entitlement, looking at that picture immediately helped him to gain some perspective and stabilize his confidence. For him, this strategy really made a difference, because for the first time in his quest for emotional discipline, David got to use comedy instead of negativity. This fit with his general worldview that life is funny and often absurd. Recognizing his emotional state as cartoonishly overconfident made the faulty logic behind his emotions easy to challenge. This lighthearted perspective has allowed him to manage the peaks and valleys of trading with stability in his confidence and consistency in his routines. He now trusts his methodology, no more jumping ship, and that has led to consistent growth in his account. Mapping your confidence. Recognizing the signals that confidence is rising too high or falling too low allows you to quickly contain and minimize the damage to your execution. Going through the process of mapping those signals is essential to being able to recognize in real time when your confidence has become unstable so that you can quickly regain stability. Plus, it also provides insight into the flaws causing your confidence to fluctuate and the sections of this chapter you need to emphasize. Follow the steps below to help you create an actual document that maps your confidence. Step 1. Unlike the prior 3 chapters, you're not just going to focus on recognizing the signals of a problem. You're going to start out by mapping what stable or optimal confidence looks like for you. This gives you a target to aim for and makes it easier to identify when confidence has risen too high or fallen too low. Even if you don't experience it very often, every one of you has a version of stable confidence that's unique to you. Write down a short description of what it looks like. Here are some questions to get you started. What does it feel like when your confidence is balanced, neither too high nor too low? What is your decision-making process like? Describe the quality of your focus. Describe your energy level. Do you feel calm, fired up, or somewhere in between? Are you in the zone? Does your mind seem clearer? Does your sense of time speed up or slow down? Take notes after each instance when you have stable confidence. Build your understanding of what it looks like until your notes become repetitive and it's clear there's nothing more for you to add. If you're currently in a period where you're struggling and your confidence is low or too high, you may find this step hard. Do the best you can now, and then add more details the next time your confidence is stable. Step 2. In addition to describing stable confidence, pay close attention to the fluctuations in your confidence. Do you tend to predominantly become overconfident or lose confidence? Or do you cycle back and forth from one to the other? Examine and capture what causes your confidence to go up and down. Be specific about signs of overconfidence and/or a lack of confidence, including thoughts, emotions, things you say out loud, behaviors, actions, changes to your decision-making, changes to your perception of the market, opportunities, or current positions, trading mistakes. Even when your confidence is low, I encourage you to look for subtle signs of overconfidence too, such as having excessive conviction, being too certain about the future, or being overly complacent. Keep a document open on your computer or a notepad next to you while you trade and take notes. At the end of the trading day, review what you found and add additional details. Be as comprehensive as you can. Mapping is an iterative process. You're not going to identify all of the details perfectly at first. Keep an eye out for new details and be sure to add them. Small details matter and can make the difference when you have an opportunity to improve execution. If this is hard at the beginning, don't worry about it. Everyone has their own starting point. Use what you find and build on it over time. As long as you keep it in your mind, you'll continually learn more than you knew before. Progress is progress regardless of the speed. Here are some questions to get you started. Low confidence. What situations typically cause you to lose confidence? For example, losing faith in your strategy, seeing other traders make money, or finding it hard to come up with new ideas? How does your body react when you're low in confidence? Do you move more slowly or slouch in your chair? Can you describe the point where confidence drops too low and becomes a problem? What specifically is going through your mind? What thoughts do you have? How is your decision-making process different? Overconfident. What situations typically cause you to feel overconfident? For example, big winning trade, getting a lot of praise, or being ahead of your goal for the month. How does your body react when you're feeling overconfident? Are you restless and can't sit still, amped up, or aware of adrenaline pulsing through your veins? Can you describe the point where confidence becomes excessive and turns into a problem? What specifically is going through your mind? What thoughts do you have? How is your decision-making process different? If you also go through periods of low confidence, is that drop preceded by overconfidence? Frequently, traders have a tendency towards one or the other, overconfidence or a lack of confidence. But you may have to go through a few cycles of results being up and down to get a clean map. Some of the triggers for the swings in confidence may not happen that often, so you may not get a perfect map for a lot longer than would be ideal. That places a greater emphasis on spotting the smaller fluctuations or triggers because they're typically still related to the larger ones. Step 3. Once you've gathered a lot of details, organize what you found by scaling them. Due to the unique nature of confidence, there are a few ways you can do this. If you tend to only lack confidence, you could set ideal confidence at 10 with 1 as your lowest level. If you tend towards overconfidence, you might do the opposite, where 1 is your ideal level and 10 describes you at your most overconfident. Finally, if you tend to cycle between the two, you can do 1 for each or combine them by making 5 your ideal level of confidence, levels 1 to 4 reflecting a lack of confidence, and 6 to 10 highlighting overconfidence. However you organize your levels, at each one be sure to identify details that clearly distinguish it from another level. As you assign levels of severity, also split them into 2 categories: the mental and emotional side of confidence and the technical side. They sit side by side. So for example, level 1 on the mental and emotional side corresponds to level 1 on the technical side, and so on. The example below illustrates a scale that puts 5 in the middle as the ideal level of confidence, with 1 to 4 reflecting lack of confidence, and 6 to 10 reflecting overconfidence. Confidence level. Describe the thoughts, emotions, things you say, behaviors, and actions that highlight each level of confidence. Complete at least 3 levels. 10. Feeling invincible, euphoric, thinking about what I'll do with all the money I'm going to make. 8. Everything I do is right, not thinking about potential for losses, amped up and feel blood coursing through me. 6. Expect the next trade to hit, excited. 5. Confident and calm, no extra thoughts, certain on what I'm looking for, able to trust my intuition, losses barely register. 4. Pessimistic, assuming open positions will lose. 2. Self-critical and discouraged, question the viability of my strategy, feel like I want to give up, but I'm still fighting. 1. Knot in my stomach, can't see how I can make money. Technical level. Describe the quality of your decision-making, perception of the market, opportunities or current positions at each level of confidence. 10. Get even more aggressive with targets, certain they'll hit. 8. Take bigger position sizes, harder time letting go of trades and adhering to stops. Take more trades than normal. 6. Making faster decisions and taking on more risk than ideal. 5. Easily stick to my game plan while sensing what the market is giving me and adapting to it. 4. A bit hesitant but still executing well. 2. Looking for perfect trades so I don't take many. Overly worried about a reversal when I do. 1. Stop trading. With that, you have a solid draft that you can use while you're trading to recognize your pattern and quickly respond with the correction. Since these patterns can take a lot of work to correct, don't revise your map until you get consistent evidence that it is permanently changed. Now use what you've identified in this section to focus on the specific causes of instability in your confidence most relevant to your trading. I strongly advise that you read through all of them because you may identify issues that you didn't realize you had at first glance, and you may think of additional details to add to your map. Correcting cognitive illusions and biases. As I've mentioned before, there are some people who believe cognitive biases can't be changed and that your only defense is to learn about them so you can avoid them. However, biases can be changed when you correct the faulty reasoning behind them. The first step is to identify the ones that affect you. and then dig in to see what's feeding the illusion or bias. There are many biases and illusions that affect traders. You can do an online search and find hundreds of them, such as the gambler's fallacy, where your sense of probability is altered, and the recency effect, where you overweight the relevance of information that you've heard recently. This section focuses on the biases that most commonly cause instability and impact the confidence of traders. You might find others that affect you personally, and by all means, use my system to break down and address them. Illusion of control. Having control is fundamental to our existence as people, not just as traders. We constantly strive to increase our ability to control our lives, and the same is true as traders. But problems arise when there are elements of trading, the market, or your mental game that you believe are within your control when they're not. For example, price action, opportunities to make money, and tilt before having worked on it. Too often traders assume they're in more control of these elements than they are, and that further impacts confidence. In the short term, it's hard to know for certain the limits of our control. It's in this uncertainty where illusions thrive. Believing you're in more control of your trading or mental game than you really are is the primary reason for instability in your confidence. Here are 7 common causes. 1. Belief that you can make money in every trade. There's a distinct difference between wanting to make money from every trade and believing or expecting that every trade should be profitable. This belief gets reinforced when you're running hot, fueling overconfidence. Then as your results turn negative, you force trades in an attempt to make even more money. In the beginning of a drawdown, some traders will remain defiant and overconfident, generating more mistakes and losses. Others crack, and the belief that used to provide confidence is shattered. The downward mental slide turns into a free fall. After moments like this, when confidence is shattered, traders look to put the pieces back together and rebuild the confidence they had before. But when your confidence was based in part on an illusion, your aim needs to be to rebuild confidence in a new way. On the surface, it's the idea that you can make money from every trade. No trader can possess that kind of control in the market or their results, and you know that. So why then does the idea hang around in the recesses of your mind? There must be a deeper reason why part of you believes that it's possible, or wishes that it could be. Perhaps you have a desire to prove yourself, or a belief that you're special. Or perhaps, as you'll see in this example of a mental hand history, it comes from a desire to be perfect. 1. What's the problem? It's so hard to accept when I have down days, and I force trades, average down, and move my profit targets to be profitable every day. 2. Why does the problem exist? I want to make money every day. I have the skills to make 5 to 10 times more than what I'm making now. To me, that's perfection, and that's what I'm capable of. 3. What is flawed? I can make 5 to 10 times what I'm making now, and have days where I lose money. That's not my problem right now. My problem is that I lose my mind and disregard a strategy that I know works, trying to be perfect. 4. What's the correction? Perfection doesn't mean profiting every day. If I'm going to try to be perfect, I should focus on perfect decisions, knowing full well that I'm unlikely to reach it, but driven to try. 5. What logic confirms that correction? I can't control the market or my results in the short term. So even if I were perfect at my execution, I would lose, often. But I'll lose a lot less focusing on making the decisions within my system. Make sure the correction to this illusion is at the forefront of your mind. Start the day by reinforcing the limits of your control and where your control lies, your preparation, execution, focus, etc. This trains your mind to focus more on what you can control and less on what you can't. 2. Illusion of emotional control. Traders who haven't yet worked extensively on their mental game often have an inflated sense of the degree to which they can control their emotions. Simply put, you expect to always be in control, regardless of how intense your emotions are. You don't consider the brain's ability to shut down higher brain functions when emotions become overactive. When this happens, you can't control your emotions as well, because the part of the brain responsible for emotional control has stopped working. Consequently, you lose confidence when failing to prevent yourself from making greedy, risk-averse, or tilted trades. The assumption is that you should know better, and that they should be easy to avoid. It's inexplicable why you couldn't stop yourself. There must be something wrong with you, but you can't determine what it is, so confidence drops. This illusion of control is such a problem that I often warn clients that once they've gained knowledge and recognition, they'll mistakenly believe they can control their emotions. Despite the warning, the problem still crops up because of the hidden belief that they should always be able to control their emotions. Burn this into your brain. Recognition does not equal control. The good news is that the answer to this is quite simple, but for some it may require a lot of repetition. Deep down you believe that controlling your emotions should happen as easily as breathing. That means you're trying to correct a larger myth, that you can magically control your emotions. It's not magic. Instead, you build that competency when you firmly understand how the brain functions and how to truly correct your emotional reactions, something I'll discuss more in Chapter 9. Be really honest about how weak that skill is, and understand and accept that it will take some work, time, and effort to get right. 3. Predicting outcomes. The mind is always trying to predict the future. However, problems arise when you start to believe your predictions will definitely happen. For example, when you're in a drawdown and assume it will never end, or when you're running hot and you feel like it's only a matter of time before you're driving the Lamborghini you've always wanted. You may also find yourself making more subtle predictions at times, such as thinking, "Today is my day." You start the day excited and eager to battle the market. And this excessive certainty helps you manage small losses or wins. But if your results become outsized in either direction, your ability to maintain discipline and manage your reactions may be compromised by the overconfidence that started your day. Conversely, when you're thinking negatively about the future, it wears on you. You assume that today isn't your day and you won't make money. You check out mentally, lose focus, put in less effort, miss trades, and undersize the good ones. You say things like, "I'm not feeling it," and stop trading to avoid losing. You're lacking confidence simply because you believe your negative prediction is accurate. Both scenarios are caused by the illusion that what's happening now will continue indefinitely. In your mind, it's as if you press the repeat button, and today's reality will just continue to play out in the same way in the future. A great run or a drawdown is assumed to continue, and that causes an excessive rise or fall in your confidence. This in turn affects your preparation, execution, and ability to respond when problems hit. I've talked in the prior 2 chapters about this problem contributing to anger and fear. If you haven't made as much progress in correcting those issues as you would like, it may be because the issue is more rooted in confidence than pure fear or anger. The correction of this problem comes by firmly understanding that your predictions are not certainties, they're estimates. You're not considering a range of possible outcomes and assigning probabilities to their likelihood. Instead, you're convinced that you're going to make money on a trade, lose money for the day, get stopped out, or hit your profit target on the trade even when you're only 75% there. You feel justified in these predictions because they feel like they're going to happen, and that's how you know there's an illusion at play. Your job isn't to know what's going to happen. You manage the inherent unpredictability in the market by making probabilistic bets within a system. Recognizing the feeling of excessive certainty, whether it's positive or negative, is a big part of how you correct this illusion and develop stable confidence. Write down a list of things you think or say when your conviction is excessive and when it's optimal. This will help you to distinguish the difference in real time, so you can dial down your degree of certainty in spots where you actually don't have it. You may also need to dig deeper and use the mental hand history to understand why you need that excessive certainty. What's the weakness in your confidence that forces you to make assumptions about the future? For example, excessive certainty could come from a desire to mask weaknesses in your decision-making process. Perhaps it's not as robust as it should be because you're half-assing the process. Attempts to emulate the confidence that you see in other traders you respect and aspire to be like. A wish that you could know what's going to happen. Obviously, you'd make quite a lot of money that way. Getting to the root of what drives your need for excessive certainty is key to being able to consistently treat your predictions as predictions, not as fact. You know that's how it should be, but you have to do the work to get there. 4. Ignoring the influence of variance. Some traders think in the short term that they're in full control of their results. They revel in profits that aren't entirely their doing, and they berate themselves over losses they didn't cause. Variance is tricky, making it difficult to distinguish the degree to which your P&L is a result of your edge. But traders who struggle with this illusion of control neglect to actively develop a skill that can stabilize their confidence and emotional reactions to their results, the skill to recognize variance. Your first reaction after reading this may be to assume that your ability to recognize variance can improve. But think about your ability to spot variance now compared to your first year. Even though it still may be weak relative to what would be optimal, you've improved. Now imagine if you worked on it directly. At a minimum, it will help you to reduce overreactions due to variance in either direction. Here's how. Before looking at your P&L for the session, make note of the trades where you suspect variance was a larger factor, and estimate the degree to which it impacted your results. Then gauge your performance or level of execution and estimate your P&L for the day. Finally, compare it to your actual results. Following these steps will give you a different feeling. If you were unhappy with your execution but had higher profit than normal, you should feel less positive and more concerned with how to execute better. On the flip side, if you lost money but were happy with the trades you took, you should feel less negative than normal. The value here is not to attain perfect accuracy. It's getting you to account for variance in a more deliberate way so you can view your results more objectively. What if you already know this, account for it, but still can't help but get caught up in the wave of blaming yourself for losses and or getting too high for the wins? Then you know it's not really about variance, and it's connected to one of the other confidence issues discussed in this chapter. 5. Unrealized potential. This problem is more commonly found among aspiring traders than veterans. You deeply believe in your potential and envision yourself being successful, maybe hugely so. You're highly motivated to prove yourself and realize that potential. Your belief is so deep that you can actually feel the success you envision as if you already achieved it. Confidence artificially rises because imagined results produce positive emotions, even though they could take a long time to attain. It's as if your confidence is already priced in those results. Not surprisingly, like an inflated market, it doesn't take much for your confidence to crash. It's fragile, and even a standard losing day is enough to expose the illusion. It's easy to get caught up in enjoying the confidence and inspiration that comes from being excited about your potential, which makes this flaw easy to miss. You don't see the harm because the consequences aren't immediate. You enjoy the feeling of success, unaware that it creates instability in your confidence. For instance, normal risk calculations are based on the size of your book today. When you suffer from this illusion, however, you could get ahead of yourself and take on more risk because you just assume growth in your account is inevitable. When you revel in your own future success, you also make losses more painful. Why? Because now a loss feels like something is being taken away from you, even though in reality you haven't earned it yet. You must understand the importance of balancing a strong belief in your potential with appreciation for all the steps required to realize it. The more you embrace those steps, the easier it is to keep yourself from enjoying future success prematurely. Be both aspirational and realistic. Dial back your level of certainty about the future, and keep working until you have the results, knowledge, and experience to realize the success you envisioned. 6. Handling feedback. You can't control what people think of you, just as they can't control what you think of them. But it's easy to overreact when being praised or criticized. Pay close attention to the way you're overly influenced by those comments, as it highlights the weakness in your confidence. For example, some of my professional golf clients were standout juniors who received heaps of praise from those around them. "You're going to be on tour, competing with Tiger," people would say. After a bad tournament, however, those same people would pepper them with questions, inquiring what went wrong. The players felt like they needed to defend themselves and prove that they played pretty well, even though that wasn't reflected in their scores. You may similarly feel a need to defend yourself against questions that come after some losses. The key is to assess the legitimacy and the competence of the person making the comment. As junior golfers, my clients didn't yet possess the sophistication to understand they needed to be skeptical of even the praise they received. It often came from uneducated sources. A part of their confidence needed that praise and loved the idea that other people thought so highly of their game. But the reality is that no one could say for sure whether they were going to make it on the PGA Tour. Just like no one can say for sure that you'll be a successful trader long term. If there's a part of you that needs assurance and praise from others, you risk those comments artificially raising your expectations and causing overconfidence. On the flip side, negative comments can prey on that need for approval and cause you to be defensive, more doubtful about your prospects, or defiant and motivated to prove them wrong. External feedback, both positive and negative, should ideally represent only a small portion of your overall confidence. Otherwise, your mentality, emotional state, and execution is overly dependent on others. You give up control. Recognize the times where you defend yourself or revel in praise as signals of a weakness in your confidence. 7. Expecting to always be at your best. Being at your best mentally requires that you have full command of the variables that cause your energy, emotions, and mental state to fluctuate. The traders who are able to frequently perform at their best operate from a base of stable confidence. They don't expect to be at that level. They do the work necessary to reach it. In contrast, you just blindly expect to be at your best, and that's a cause of instability in your confidence. Remember back to Chapter 3, where you learned from the inchworm concept that your C game, or your worst, is the only part of your skill set that you can truly expect. Everything else is in the process of being learned and requires effort and attention to attain. You can't control your A game. When you expect to be at your best, you signal to your brain not to focus on the skills currently being learned. You believe your A game is automatic, so you presume to have full command of the variables that produce it. Ironically, by expecting to be consistently at your best, it's practically guaranteed that you won't be. Expect your worst and drive hard to be at your best. An extreme version of the illusion of control that many newer traders have and that's important to correct is highlighted by Goro, a client from Japan who started trading cryptocurrencies early in 2017. At that time, he was still working full-time as an engineer, but by the end of that year, he would quit his day job to trade full-time. Soon after he started trading, however, Goro began to feel tremendous pressure. The crypto market was bullish at that time. He made money in his first trade, and soon after he was making a lot more than he was from his full-time engineering job. He started thinking he could quit and easily make 6 figures just by working an hour a day. But the market was volatile and had several major corrections that this novice couldn't handle, tactically or mentally. The tension was exacerbated by the fact that his wife was pregnant with their first child, and they were at the time living in the US with no friends or family for support. He became obsessively focused on the crypto markets, and he wasn't sleeping well because he'd get alerts throughout the night. This strained his marriage, because not only was he not there for his wife during her pregnancy and in the months that followed his son's arrival, but he started losing money on top of it. Goro felt like he was failing his family, and it was at that low point when he and I began working together. In the first several sessions, we found that at the root of Goro's issues were the illusions that he could make easy money, make money from every trade, and always be at his best. One day we discussed whether he would rather be the luckiest trader in the world or the most skilled, and he immediately replied that he would rather be lucky. That was the turning point, and this mental hand history helped him to clearly see the problem. 1. What's the problem? I want to have superhuman power that will allow me to maximize profit and eliminate loss from every trade in an extremely unrealistic way. 2. Why does the problem exist? I've had this illusion for a long time that it was possible to have superhuman abilities, and deep down I must think it's possible. 3. What is flawed? I have 25 years of life experience to prove that it's not possible to have such power, and if I continue to think this way, I'm basically a 7-year-old. Look at the chaos this one belief is causing in my life. I'm essentially thinking that I can win the lottery. What if I win it? Will I have anything left other than money? If I don't win, then I'll have neither. 4. What's the correction? Since I don't have superhuman power, the only thing I can do is to do the work necessary to become a skilled trader and accept that no matter how good I become, I can't always be at my best and that not all trades will be profitable. 5. What logic confirms that correction? This is the only way to achieve financial freedom through trading. Unless I want to be a lucky fish who wins the lottery, I need to correct this illusion or risk ruining my life. From that point, Goro started to treat trading with the seriousness required. 3 years later, as I write this, he continues to trade crypto as well as other markets. Emotionally, he's graduated from the deeper illusions to more practical problems that I typically see with veteran traders. FOMO and anger pop up from time to time with some flashes of overconfidence. Goro estimates that his emotional volatility has decreased by probably 75% since we first began working together. The 25% that remains, he's very aware of when it happens and knows how to correct it. For example, as soon as he thinks, I'm a genius, he makes certain to stick to the plan and looks for a good opportunity to take profit or close the trade. Illusion of learning. If you previously were unfamiliar with the inchworm concept, you may have developed errors in your belief about learning. These flaws cause emotional volatility, including confidence problems. You falsely assume things about your development as a trader, creating confusion and pessimism. Or conversely, you get ahead of yourself too easily and think aspects of your skill set have already been mastered when they haven't yet. Correcting these errors is necessary to develop stable confidence. Additionally, here are some of the more common illusions of learning that impact confidence. 1. Premature mastery. When on a good run, it's easy to be fooled into thinking that aspects of your skill set that are currently being learned have actually already been mastered. This mistake essentially means you think you have crossed the finish line when you haven't yet, like being at mile 21 of a marathon. Close, but you're not there yet. Perhaps you've been in a good emotional state for several weeks, making some money, and you've relaxed a bit, assuming your tilt is handled. Then tilt pops back up unexpectedly, because you stopped actively thinking about the corrections to your tilt. A couple of losses triggered tilt, your mind malfunctioned, and you made a bunch of mistakes. In the aftermath, it's easy to lose confidence, both in your ability to control tilt and the strategy to correct it, even though the actual problem was getting ahead of yourself. The same thing happens when you make trading mistakes you thought were no longer an issue, and you start to question your competency as a trader. When you reach this stage of the learning process, you feel in such command that it seems like you've mastered it. However, reverting back to incompetence at any time and for any reason is proof that skill is still in the process of being learned and requires more work before being fully mastered. Prior to this book, you didn't have a theory or structure to understand why these mistakes were happening. You got ahead of yourself because you didn't know any better. One thing that can help you to avoid this problem is understanding the signals that indicate when you've achieved mastery. A critical marker is consistent preservation of your competence under intense situations where you might have previously hesitated, tilted, been fearful, greedy, or emotionally volatile. Another signal is the complete absence of these mistakes within your B game, whereas before you still had the thought or impulse to tilt or force a trade. Until you've gotten those indications, keep running the race. Those mistakes are still possible. And if you do make one, be a detective, curious as to why you made them, and get aggressive at fixing them. However, if you can't stop yourself from assuming you've achieved mastery prematurely, there may be a part of you that's desperate for success. As a result, you latch onto any indicator that you're going to be great, will be able to quit your job and trade full time, or make a ton of money. You're compelled to get ahead of yourself because you're so desperate to attain your goals. Desperation is a topic I talk about later in this chapter, so be sure to read it. 2. Assume that you're smarter than others. Like athletes who assume their athletic talent is greater than others, traders with this bias assume they're smarter than others to bolster their confidence. It's a subtle issue, and a bigger problem for traders who are more competitive with other traders than with themselves. If you're the type to constantly look over your shoulder to see where you rank within the firm, or even within a trading group, you're likely jockeying not just for profits and dominance monetarily, but for proof that you're smarter. You may say things about other traders like, "This guy's an idiot. I can't believe he made that much last year." When you miss opportunities others capitalize on, or losses pile up, you're quick to make excuses. Taking the blame would be an admission that you aren't the smartest in the room, and you can't allow your confidence to take a hit. The main cause of this is a fixed view of intelligence, which comes from an old school mentality that you're either smart or not. When profit is how you prove intelligence, your confidence ends up rising and falling based on the movement of your P&L. You feel like you're only as good as your last trade. There's no lasting permanence to it. Some traders feel this movement more dramatically, while others deny there's a problem, become defiant, or become arrogant to prevent their fragile confidence from dropping. Changing your view of intelligence is important because it's harming your ability to compete with other traders. You end up underutilizing your capacity. You're not learning from losses and mistakes, or at least not efficiently. You're more focused on preserving your position as the smartest, rather than understanding that intelligence is a tool that helps you to execute and learn. The key to evaluating yourself in the short term and still preserve confidence is to embrace the interim concept. For argument's sake, let's assume you really are the smartest one in the room. Like athletes who rely too heavily on talent alone, you'll still get beaten by other traders who work harder, who learn from mistakes faster, and who are more open-minded. To broaden your view of intelligence, you must remove the association that P&L equals intelligence. Embrace the reality of your own weaknesses, and more firmly reinforce the idea that everyone has weaknesses. The faster you embrace yours, the faster you'll be able to improve on them and move your entire range forward. If you haven't already done so, I recommend you complete the A to C game analysis that I describe in Chapter 3. It gives you a way to see intraday performance in a non-monetary way. You'll also better understand the causes of fluctuations in your performance and correct them faster. If you can shift the use of your intelligence in a much more practical way, it will give you greater stability in your confidence, improving your overall performance. I also suggest you read Carol Dweck's book, Mindset, The New Psychology of Success. It's a fantastic resource for understanding a fixed view of intelligence. 3. Hindsight bias. You believe a mistake or loss could have been avoided if you thought longer, had read an obscure piece of news that others saw, hadn't hesitated, or fill in the blank with another excuse. As discussed in the section Mistake Tilt, hindsight bias includes a fantasy-like way of analyzing what you could have done differently. You believe your mistake should be easy to fix because you now see what you could have done differently. That's fiction. If it were that simple, you would have made a different decision. This fantasy comes from an inflated sense of your own competence. This problem is called hindsight bias, but really it comes from an expectation that you know the future, as if you should have the ability to know what factors to consider, what to read, when to pull the trigger, or what else could have avoided the mistake. As you look back and identify your mistakes, it feels like you should have known better. But to do that, you would have to know a mistake or loss will happen before it happens. Of course, that's impossible. So what's this really about? What would happen if you were honest about why you failed? What would happen if you didn't make excuses and instead acknowledge that you could have done better? Does it feel bad? Would it cause you to lose confidence? Do you become pessimistic about your prospects as a trader? Do you expect yourself to be perfect or believe that you could be? The answers to your questions reveal what hindsight bias is protecting. Once you know what you're protecting, that's the problem to work out. Make that problem step 1 of the mental hand history and use the corresponding section in this chapter to help you fill out the remaining 4 steps. Confirmation bias. One of the fundamental skills of successful traders is the ability to quickly recognize when you're wrong. When you suffer from confirmation bias, you lose that skill because your confidence is based on the need to be right. Instead, you automatically seek out information to confirm your existing belief and ignore opposing viewpoints. You lack a thorough analysis of what information is filtered in or out and can have a hard time reevaluating your opinion. You're more likely to ignore contradictory suggestions from other traders. You rigidly hold onto a position in the face of mounting evidence that it's a dog, or you might quickly jump on the first bit of information that confirms your opinion about a potential trade. In reality, you can have confirmation bias for almost anything. It could be views of another trader, assumptions about the opportunity in the market this quarter, or thoughts about the type of job a CEO is doing. Perhaps you believe that you're unlucky and destined to lose, or that you're going to make millions. You could be certain a stock will rise because you personally love their products. You can believe a tech stock is poised to pop, pointing to the positive media coverage, and you're so certain of this that you don't evaluate the trajectory of advertising spend or whether the customer base is shrinking. Confirmation bias is less about the specific belief and more about a rigid attachment that you have to it. This attachment blocks out opposing viewpoints and shuts down rigorous analysis. Or worse, a more severe version of confirmation bias, you just have to be right. As a trader, your livelihood depends on a clear perception of what's happening, so you can evaluate opportunities as they are, not as you want them to be. Only when you're realistic do you put yourself in the best position to succeed long-term. To begin cracking through confirmation bias, you need to understand what's driving it. Why do you want to confirm what you already believe is true versus finding out what's actually true? Why would you want to stop learning? At a basic level, you might lack the skill to properly evaluate opposing viewpoints without losing your perspective. Perhaps you're too easily influenced by other people. Or you could be afraid that you're going to look stupid. Maybe you're unconsciously protecting yourself from finding out that you're not as good as you think, and that your results to date have more to do with luck than skill. Perhaps you want to be top dog in your firm or group and want the respect of your peers, but you don't have the results to prove it yet. So you think less of them to boost your own confidence. Confirmation bias blocks you from identifying gaps in your skill set, knowledge, and perspective, and it stops you from learning. The most basic way to begin correcting this is to identify the beliefs that you're most rigidly attached to. Look for beliefs, ideas, or statements that have been looping in your mind, day after day, month after month, and even year after year, without changing. If you were truly evaluating information objectively, the story would at least evolve. Instead, the story hasn't changed. Your bias is fixed and you're not open to counter-arguments. Get better at being rigorous in your analysis. Learn how to understand arguments on the other side and prove your point in the face of that argument. Blindly making assumptions is weak. Try to understand and have your perspective grow or evolve. In the end, your belief might not change, but the rationale that surrounds it becomes strengthened by having to defend it in a more rigorous way. If that doesn't sufficiently correct your bias, then it suggests that you have a deeper need to just be right. Proceed to step 2 of the mental hand history to uncover why you're so rigidly attached to being right. It could be caused by some of the examples I gave previously, or you may be defending against the idea of being wrong, indicating a deeper insecurity or weakness in confidence. In that case, you need to understand what's so threatening about being wrong. It's possible the answer extends beyond trading and is personal. Here's a sample mental hand history. 1. What's the problem? I have a strong urge to prove to myself that I can do this. I try to force a high R multiple so that I can step it up. 2. Why does the problem exist? If I'm getting high R multiples, then it's proof that I'm doing this right, and validation that I should step it up. 3. What is flawed? Actually, no, it's not proof. I could be getting lucky. And if I were getting false confirmation, I would unwittingly set myself up for a crash that would be far more painful than the short-term missed opportunities that I could have had trading outside my system. I'm also developing bad habits that I'll have to fix later on. 4. What's the correction? I want and need validation through the system. I need to focus solely on execution for the next several months. Nail it so that I can build the competence and set the foundation to level up. 5. What logic confirms that correction? Getting this far is validation in itself that I'm doing something right. I don't need validation day to day for my results. The Dunning-Kruger effect. This concept refers to the tendency of poorly skilled performers to overestimate their abilities, and conversely, for highly skilled performers to underestimate their abilities. In trading, that means on one side, traders with very little skill become overconfident because they're unable to recognize their own incompetence. They're unaware of how bad they are, and they falsely assume that they know more than other traders. On the other side are highly skilled traders who falsely assume that others share their level of knowledge and who undervalue their own competence, resulting in artificially low confidence. This concept epitomizes why confidence isn't an accurate measure of competence or future success. If anything, reality would suggest that traders on either side of this issue should feel the opposite of how they do. The commonality on both sides is a false assumption about your knowledge relative to other traders. Let's look at why your analysis might be flawed from the underconfident side. Perhaps you were raised to be humble, never gloating about yourself, your accomplishments, or what you know. Or it may come from anxiety, nervousness, or fear of standing out, and not wanting the attention or perceived expectations that come with it. You may also be aware of how many massively successful traders and investors are out there. Not having reached that level, you automatically undervalue what you know. This false perspective can be reinforced because it's much easier to look at traders more successful than you, especially those covered in the media, than it is to look behind to see how many traders are less successful than you. On the flip side, if you're overconfident relative to your actual competence, why are you so unskilled in recognizing your own weaknesses? One reason can be a belief that dominates in Western societies that you can accomplish whatever you put your mind to. This often comes with a general tendency towards denying weaknesses and emphasizing strength. Or your overconfidence might come from insecurities, where you demean other traders in order to elevate your own confidence. The classic, step on somebody else to make yourself feel bigger. So you assume other traders who don't think like you are dumb, even if they're far more accomplished. Whether you're an overconfident weak trader or an underconfident strong trader, to correct this problem, I suggest completing the A to C game analysis in Chapter 3. While you may never achieve a flawless analysis, gaining a clearer perspective on your strengths and weaknesses can help you to avoid adopting a misleading level of confidence. You may also need to establish if there's insecurity or a deeper weakness in your confidence that cause you to become overconfident or underconfident. The mental hand history is the tool to help. In my experience, this is often connected to a personal issue that extends beyond trading. When completing the mental hand history, I encourage you to think in more personal terms, even if the problem isn't showing up anywhere else in your life. Often trading can challenge you in ways that other parts of your life don't. So unresolved personal issues emerge in trading and need to be fixed to stabilize your trading confidence. Black and white thinking. Evaluating mistakes, losses, the market, or others in a black and white, all or nothing way is a hidden flaw that can underline many of the illusions and biases that I've already described. When you have a knee-jerk reaction that's truly polarized, your language contains words like always and never, or you assess your performance as either perfect or terrible, and you often oscillate between one and the other based on your results. Results in trading are black or white, but you can't evaluate yourself as a trader like that. Otherwise, you're going to have strong overreactions. To see if this is a problem for you, pay attention to whether you often make extreme statements about yourself, other traders, the market, or trading opportunities. The common denominator is whether you have a polarized way of categorizing things, classifying them without any gradation or range. For traders who tend to cycle between being overconfident and underconfident, this flaw may be part of the reason. You flip from one side of the coin to the other. Feeling confident, you see yourself as a genius. Not feeling it, you consider yourself a fraud who's merely gotten lucky. This flaw was a main cause of Max's problems with greed, and ultimately confidence. Remember, he's the Forex swing trader who had a 10-level map of his pattern of greed. If he had a losing trade, Max would begin to worry about his competence and his monetary return. He wanted to be more profitable than other traders to prove that he could be successful. There was a distinct need for his competence to be recognized by others, as well as himself. Losses would make him hesitate to take another trade. He would overly focus on what he was doing wrong, and at times start to doubt his competence and think he just wasn't a good trader. He'd have to shut it down for a few days to reset. Before we began our sessions, Max assumed all traders had emotions that interfered with their performance, and he didn't know that he had the potential to eliminate these problems. Another example of black and white thinking. In our first session, we were able to unearth what lay behind his greed and confidence problems. This mental hand history shows what we found. 1. What's the problem? When greed is at its worst, I'm driven by an uncontrollable urge to make the absolute best return right now. I'm only focused on making money right now. There's no longer-term thinking. 2. Why does this problem exist? When I'm in a drawdown, my confidence weakens. I have more doubt about my ability and my goals. There's less certainty that I can hit my targets. I need to make money now to get back to break even or profit, eliminate any doubt, and feel confident enough to say that I'm a consistently profitable trader who would eventually take on investors. 3. What is flawed? I have a deep desire to prove that I can do this. The more that I can support myself, the more I prove that I can do this. This desire is healthy, but is taken to an extreme because I need to prove it right now. I don't want to prove it in 1 or 2 years. I want to prove it now. 4. What's the correction? I can't skip steps. If I want to build a big house, I can't build the 3rd floor before I build the 2nd. I know what I'm capable of, and I know what I've proven to myself already. 5. What logic confirms that correction? My confidence is weakened because my perception of my skill is too black and white. Clearly understanding the base of my skill allows me to know that there are always some aspects of my skill set that don't disappear. That allows me to progress in a more linear way and to have the patience to avoid impulsively jumping into marginal trades and instead only take the best ones. To help break out of the black and white way of viewing his competence, I had Max identify all the skills and knowledge that he's mastered in trading so far. All of the things that he's good at automatically and doesn't need to think about anymore. For example, being able to identify the market structure, where the key trend lines are, and support and resistance levels. I suggested he read and think about the list daily for 3 to 5 minutes. What Max quickly realized was that he is a competent trader with a solid foundation that has been built up through thousands of hours of testing by being involved in the market. Shortly after completing this exercise, his first signs of progress emerged. Max began seeing short-term decisions from a long-term perspective, allowing him to take trades he otherwise would have avoided, and to accept losses without the urge to immediately make the money back. He also found that he could avoid the urge to close out a trade below his target and stay away from trades that didn't meet all his criteria. The latter bit of progress was quite remarkable, and in 2 instances he noted, "It was way easier to be on the sidelines. Even though they were both in profit, I'm happy that I didn't take them. Why would I break my plan that I spent thousands of hours to create?" Max still experiences the signals of greed and a weakness in confidence, but his awareness is so strong now, it rarely affects his execution. Plus, with such a strong ability to handle losses, he's now taking more trades and even doing some day trading, something he could have never successfully done before because of his emotional volatility. For you to correct a polarized way of evaluating, you must, as Max did, identify the situations where you tend to be the most polarized and integrate a perspective with gradation to it. If your polarized reactions are related to your own competence, completing the A to C game analysis is a great way to start. You'll likely only have an A or a C game to start, and the task of identifying your B game will significantly help to correct this flaw. If your categorization is related to other traders, build an understanding of where their performance contradicts how you label them. For example, if you have written them off as idiots, consciously look for indications where they perform well and have good ideas. Conversely, if you lionize them as infallible, bring them down to earth a bit for yourself by identifying weaknesses and the places where they make mistakes. If your polarized language is related to the market because you're always getting screwed and never getting your fair share, begin tracking variance. Look for examples that disprove those statements, then begin to build more nuance. This may be enough to get you to change the specific places where your reactions are too extreme. If not, you need to further investigate why your evaluation is so polarized. Perfectionism. Perfectionism is complex with different degrees of severity. Entire books are written on just this one topic. I've also discussed it several times in this book already. In Fear, you learn that the standard of perfection can loom over you and add so much pressure that it can paralyze your decision-making. In Tilt, you saw how expecting perfection caused anger that further degraded your execution. Now let's go a bit deeper, exploring how perfectionism or high expectations damages confidence, and some different ideas on how to solve it. The crux of perfectionism is having outside beliefs about your own capabilities. This is why the advice that no one is perfect or failure is an opportunity to learn are niceties that don't strike at the root of the problem. Traders are analytical and need more information. You don't make trading decisions based on general advice. You dig. The same is needed here. That doesn't mean that we have to delve into the personal. There are some common performance-based causes of perfectionism that you might not yet be aware of. While some traders have a healthy striving for perfection, often a driver of high performance, it can also be a double-edged sword. The downside occurs when the drive for perfection becomes excessive and creates emotional volatility. That volatility can cause every type of trading error you can imagine. It can also slow progress and create dissatisfaction, which can then lead to burnout and to finding your motivation and dedication slipping backward. I want all of you to be driven to be your absolute best and to find your own version of perfection. But in order for your attempts to strengthen confidence, they need to be balanced with some understanding about the nature of perfection. Perfectionism is not bad. That's too crude of an analysis, which doesn't account for the upside it provides. Instead, let's put a spotlight on what's excessive to transform perfectionism into something more productive. In doing so, you can blunt one edge of the sword and minimize the self-inflicted damage, while sharpening the other side that allows you to excel. First off, Inchworm is the antidote to the nobody is perfect line. Here's why that statement is in fact functionally incorrect. It's not about being perfect. That idea of being perfect is too large. No one is perfect. We all have a C game. We all have relative weaknesses. But that doesn't mean we can't at times reach our own version of perfection when we're in the zone and maximizing our capabilities at that moment in time. That's a version of perfection. You can attain it at times, just not over a large sample. Being perfect in that sense doesn't mean that you squeeze the most profit out of every day. After all, given variance, that's not even entirely in your control. It's more about your own version of perfect decision-making and execution, given your current range. Also, once you reach perfection, the standard rises. Performing at that level means the front end of your inchworm moves forward. Your capacity grows, and a new definition of perfection emerges. You have a new A game, and the easiest way to reach perfection again comes not by pressing forward from the front, but by correcting aspects of your B and C game and moving forward from the back. Whether or not you're aware of perfectionism being an issue for you, it may be helpful to read through the following list. There may be signs here that you wouldn't have recognized that fit under the perfectionism umbrella. You put a lot of pressure on yourself to be great. Constant internal pressure doesn't allow you to relax or take a break, which leads to burnout. You feel like nothing is ever good enough, even after big profitable days. You never applaud good results and assume that anyone in your shoes could achieve them. Self-criticism bubbles up over the slightest misstep, and you treat all mistakes as equal. You continually feel you're not doing enough compared to others. There's always somebody doing better. You have a hard time moving on, letting go, or getting over a mistake because you obsess over them and have regrets. You perform at your peak infrequently. You feel like you're falling behind. With those in mind, let's look more closely at two causes of perfectionism: a faulty self-evaluation caused by an accumulated deficit in confidence, and mistaking expectations for goals. Faulty self-evaluation. All of us have an internal measuring stick, in a sense, to evaluate our level of skill, get feedback on how we're performing, and identifying what to improve on. At the beginning of the chapter, I stated that confidence problems arise from flaws in your perspective of your skill. In this case, perfectionistic traders have flawed methods of evaluating themselves. It's common for traders to achieve milestones, such as their first 5-figure month, and shortly afterward think nothing of it. They fail to give themselves any credit and miss an opportunity to strengthen their confidence. Think of evaluating your skill as a game. You gain or lose points based on the quality of every trade you take or pass on. Total it up, and you get a score for the day. Daily tallies feed into monthly, monthly into yearly, and so on. The game doesn't stop until you stop trading. Perfectionists consistently fail at this game, essentially accumulating a massive debt. Your internal measuring stick is used to determine how many points you gain or lose. Perfection or high expectations represent the standard that you expect and forms your baseline. That means when you reach that level of expectation, you get 0 points. You don't give yourself credit for doing what you're supposed to. Only when you exceed expectations do you get points. But they can also get taken away after you move the goalposts or increase your expectations. The majority of time you fall below your expectations and lose points. For some of you, the scale is proportional, so when you underperform slightly, you only lose a few points, and when you massively underperform, you lose more. For others, it doesn't matter whether you've fallen slightly below or far below. Failing is failing, and you lose the same amount. In this game, points equals confidence. So where does that leave you? In debt. Well, there have been some times you've earned some points. They are strikingly low compared to the massive number you've lost. That produces a hole or a weakness in your confidence that can underlie both a consistent lack of confidence and overconfidence. High expectations initially get you into debt, but as this problem evolves, you believe that reaching perfection will get you out of it. There's a subconscious sense that if you can perform perfectly, your debt will be wiped clean and you'll now feel consistently and justifiably confident. However, once you've reached a new height in performance, you now expect this standard to show up every time. The goalposts move again. You've just jumped higher and now expect to jump even higher. The moment of satisfaction is fleeting, as your mind immediately moves on to what's next. Or you don't even experience that fleeting moment, dismissing the value of what you've attained, having already moved on to the next expectation. Either way, rather than being debt-free, you're deeper in the hole. The process repeats, and you think the bigger accomplishments, more money, status, responsibility, etc., will finally do the trick. This is why you have incredibly successful traders who are miserable. They are so driven by money they think more of it will finally allow them to be satisfied. Money can't get them out of this debt. External sources, even heaps of praise from others they hold in high regard, can't reconcile the debt. What you need to do is recalibrate your internal measuring stick and make it more accurate. To do that, you need to recognize that you've been mistaking expectations for goals. Expectations versus goals. The difference between an expectation and a goal is significant. Basically, an expectation implies a guarantee. In this case, it's a guarantee to attain the results you want, which means that you believe you either have the requisite skill or you're certain to attain it along the way. On the other hand, a goal implies uncertainty. The exact road to the end is unknown, and while the skills needed may be known, whether you can attain them and how you'll acquire them is not. Expectations just want the outcome and don't care how you'll get there. Goals come baked in with a recognition of the potential for chaos along the way. While you can be driven with the same level of intensity by a goal or expectation, there's a distinct difference in how you feel when, for example, you pursue a target to make $500,000 in a year. If it's an expectation, when you face mistakes, setbacks, or failures along the way, you're unprepared and overreact. There's a lot more self-criticism. as well as the potential for overconfidence or a loss of confidence. If you're actually able to attain your expectations, you get 0 points and feel nothing, or perhaps you even feel worse. Whereas with goals, you're prepared to handle the setbacks, and you understand the lessons and the value they provide. Goals imply learning and a lot of ups and downs. There's an implicit understanding that you'll discover new things on the road to getting there. You'll also gain a sense of pride and satisfaction for each step along the way. The result of an accurate internal measuring stick is that you have a chance to collect points as you make progress at each step along the way. You build up a reserve of confidence with each milestone you hit, so the finish line is not the first time you feel proud or satisfied. The net result is a stronger foundation of confidence that you leverage to pursue your next goal. Perhaps the most obvious difference between an expectation and a goal is how you evaluate the outcome when you fall short. As a goal, you might get upset, but rather than dwelling on it, you look proactively at the results. How or why did I fail? What did I not prepare for? Could this have been avoided? In what areas have I succeeded and made progress? What have I learned? How will I do better on my next goal? The answers to those questions immediately make you better, not only at achieving your goals, but at setting future goals. Many of you will look at this problem and assume my advice is to lower your expectations. No, I want your aspirations to be as high as you want them to be. The problem is not that you want to be perfect, it's that you expect it. The correction is not to lower your expectations, instead convert them into a goal. Conceptually, the only thing you can truly expect is your absolute worst or your C game. That's the only thing that's guaranteed. The rest of your range, B game and A game, have to be earned every day. You get credit or earn points when you do. Proportionally, of course. You also get points when you learn more about the cause of variation in your performance and when you make corrections. Spotting progress is easier when you create an A to C game analysis as outlined in Chapter 3 and use it as your measuring stick to get real-time and daily feedback. Changing how you evaluate your daily performance is the first step towards correcting perfectionism. But for it truly to stick, you must go back into your history as a trader and correct the damage caused by your old measuring stick. You need to get yourself out of debt. Obviously, you can't change what has happened in the past, but changing your perspective on it can reconcile the lost confidence that you earned but didn't accumulate. Very often, there are past accomplishments or benchmarks that at the time weren't given the proper respect, praise, or acknowledgement. It doesn't matter if your spouse, friends, coworkers, or boss lauded you with praise and even threw you a party. Your perspective is what matters. Go back and look at all the accomplishments you've had since the start of your trading career. Successfully getting off the sim, your first profitable month, the first time you made more than $10,000 from a single trade, etc. Big or small, write down as many of your accomplishments as you can, especially the ones where you felt ho-hum and didn't really feel particularly proud of or satisfied by them. As you start going through your accomplishments, keep an eye out for "yeah, but" entering your mind. This common phrase is used to downplay what you've accomplished. Yeah, but I could have made more, done more, work harder. Yeah, but compared to so-and-so, it's nothing. More is always out there. That's the way of the world. And the accomplishments of others have no relevance on what you've attained. The second step is to list all of your past accomplishments and write precisely how you achieved each one. What were the steps you took? What did you learn? What difficulties did you encounter, and how did you get through them? Now looking back on it, how is it a building block or stepping stone to where you are today? You also don't have to have a completed list before you start delving into each accomplishment. You can go back and forth. More important is how you go about listing your accomplishments and writing about them. This can't be a task that you do for 2 hours on one day and that's it. You're trying to reshape your perspective. It's far more effective to do it regularly for, say, 5 to 10 minutes a day. An accumulated deficit makes you feel like you're starving for confidence, and the next accomplishment on the horizon seems like the feast that will finally satisfy you. Only it's a mirage, and you're just eating a pile of sand. The process of doing 5 to 10 minutes per day, perhaps even several times a day, is like eating. You're feeding yourself the confidence you've been starving for. Once you've gone through this process for all your accomplishments, review them. You might even learn more as you go through a second round, further instill the correction, and strengthen the new way of evaluating yourself. Step 3 is to extract and confirm the skills or assets you've learned as a trader, especially those you've taken for granted. You can do this alongside your review of past accomplishments, but keep them listed separately. The point here is that your perfectionism doesn't care about the details of your skill set. It just demands perfection. This is your way of easing back that intensity. For example, your skills might include making quick and accurate decisions when the market goes crazy, estimating future price, preparing a clear strategy for the day and applying it at the right time. Your skills in your past give you stability. Review them at the start of the trading day. Then use your A to C game analysis as a new measuring stick at the end of the trading day and evaluate performance and progress. The combination of these serves to steadily reshape your perspective, fill the hole in your confidence, and allow you to climb higher. You'll be able to capitalize on what comes next by standing on a foundation of what you've already built. This won't happen overnight, so be aware of perfectionism related to the process of correcting your perfectionism. It can undermine your progress. The advice in this section was particularly important to Chris, the trader from Chapter 4, whose greed was connected to the pain from missing out on life-changing money. Even though it happened years ago, the regret remained constantly on his mind. If, for example, he sold a position for profit, he would immediately think about how he could have made more. As a result, Chris would often get aggressive once a trade turned profitable, and he'd try to turn it into a home run. In addition to greed, Chris experienced waves of other emotions. At times he felt invincible, as if he had cracked the market. And in this state, he would go after losers harder, assuming he'd get the next one. He figured out the market, right? So the next one had to win. Not surprisingly, his biggest drawdowns came after these periods of overconfidence. The boom and bust cycles crashed his confidence, and Chris would question whether his strategy was still viable. That would spark a strong urge to make money in order to feel good again. Chris also had twinges of FOMO and doubts about the viability of his strategy. After a string of losers, he would try to recoup them to end the day positive by forcing more trades. In addition, anger would arise after he'd get stopped out several times in a row. He'd become more aggressive and impatient and stray from his strategy by entering too soon. However different they may seem on the surface, for Chris, the signals of greed, fear, anger, overconfidence, and a lack of confidence were all related to an expectation of perfection. Chris knew he had an edge with the system he traded, but he was struggling to comprehend why he wasn't allowing that edge to play out in the long term. Over the years, he had read a ton of trading books, but hadn't gotten to the root of his problem. He was trapped in a cycle of managing emotions and couldn't sustain progress. Chris would have high moments and weak moments. There was no middle ground. He'd swing from one end to the other, and there was a direct impact on his execution. In our first session, we discussed the concepts and strategies from this section. It immediately hit home and provided a new perspective on the trade that continued to haunt him. Between our first and second session, Chris spent some time writing in detail about the trade and realized it was the catalyst for taking trading seriously. At the time, he had been in an unfulfilling job with long hours and was looking for a way out. Despite having no proven system or trading education, he got lucky and found a company that had good fundamentals. It was on the brink of bankruptcy, but there was talk that a big-name bank was coming in with funding. Chris sold his entire portfolio and dumped it all into this one stock, thinking this could be his ticket to a better life. While he made a small profit, and it was painful to leave a lot on the table, this experience was a turning point in his life for the better. It made him realize that if he really wanted to trade, he needed more expertise. He invested his profits in trading and was eventually able to leave the other job and trade full-time. Looking back on it, he realized, I would have paid $200,000 to be where I am today. Even though the regret is still there, it's significantly less and no longer triggers greed. In addition, Chris really benefited from the A to C game analysis and by journaling during trading sessions. He once swung from A game to C game, but now even taking losses, he's able to maintain a solid B game and doesn't trade outside his system. Also, his awareness of his emotions is high enough that he can quickly recognize and correct emotional reactions before they get too big. His baseline level of emotion is lower, and it no longer feels like a problem he has to manage. For Chris, knowing that he has a system for the mental game has freed him up to make progress, knowing perfection is no longer the standard. Desperation. In a flash, a mixture of anger and greed takes over. Fuck it, you don't care anymore. You switch to a 1-minute chart, triple a position as it falls, and fire off several more trades without even thinking. For some traders, their desperation is so intense it's as if they black out and wake up unaware of how they lost all that money. Maybe you're one of those who struggle more with fear and are overcome by a desperate need for certainty. Nothing you do works. Losses pile up and panic rises. You hop from one system to another, convinced these new ideas are creative, but really you're just frantic for something to work. As losses mount, greed, anger, or fear builds, making it impossible to avoid the urge to do something, anything. It gets increasingly stronger, like an itch you have to scratch. For some, winning is the only thing that can make the itch go away. Squeeze out a few winning trades or a profitable day, and you get some breathing room. But that's only temporary. Once losses pile up again, desperation returns as though it had never left. Some traders actually need to lose more in order to scratch the itch. Losing feels good because it gets the pain over with quickly and provides relief from the pressure and uncertainty. Desperation is distinguished by an intense urge to do almost anything to make money or avoid taking a loss on the day. It's often hard to recognize desperation because you're paralyzed by fear or blinded by rage or greed. These emotions are so big and obvious, they're what get noticed. But regardless of whether desperation includes greed, fear, or anger, the underlying cause is connected to weaknesses in confidence. Those emotions would not reach extreme levels if your confidence were stable. Confidence is your emotional foundation, and weaknesses are the cracks in it. Up until this point in the chapter, the weaknesses in confidence that I've covered, while problematic, have been on a smaller scale. Desperation, on the other hand, is a big gaping hole. The question becomes, why does this gaping hole in confidence exist? And what are the flaws that have made it so large? It's not just one issue. To have your mentality fall to this level means the problem is complex. You'll have multiple flaws or biases revealed in this chapter, as well as likely from fear or tilt chapters. Self-criticism, too, is a common and large part of the problem that makes desperation exponentially harder to correct. Desperation is also marked by a significant amount of accumulated emotion. The intensity of the greed, fear, and anger that show up is so strong that it instantly takes over your mind, drowning you in so much emotion that your reactions are beyond reason. Intense emotions at this level create a sense of disconnection, where you do things that don't make sense. Even though you may be aware in the moment of how irrational your reactions are, in some extreme cases, forcibly trying to control your hand on your mouse or yelling at yourself to do something different, you still can't stop from making absurdly bad decisions. Being in this state is like sitting in a movie theater watching a horror movie and screaming, "Don't open that door!" and then watching as you, open the door. If this problem has been going on for a while, the emotions have been building up for years. Even if it only recently became severe in trading, working on this problem away from the trading desk is mandatory to both decrease the old emotion and build up the discipline needed to have any chance of remaining in control in these situations. Accumulated emotion is the real wild card, and if you try to take on desperation without serious preparation, you have little to no chance of correcting it. Rather than showing up unprepared, work with a sense of urgency as if your trading life depends on it. It does. Having your mental game devolve to this point is not something that happens to all traders. This is as extreme as it gets from a performance standpoint. When it happens to skilled traders, it's hard to comprehend afterward just how badly they performed. The gap between normal execution and when desperation strikes can make it seem as if the trader is possessed by a demon. Much like a person addicted to drugs will do anything to score their next fix, a desperate trader will do almost anything to make money. But almost is the key word. The distinction between what you will and will not do determines whether you have a performance issue that could be addressed by using this book, or whether you have a clinical, non-trading problem that requires the direct assistance of a therapist or psychologist. Think about when this problem is at its worst, and consider whether you can remain in enough control to function as a trader, afford the financial losses that may happen while working on this problem, or tolerate the implications in your personal life. If you're going to work on this issue by using this book alone, you are accepting those and other potential risks, and you must be willing to work hard. You're in for a battle. In a few other sections, I alluded to the possibility that the flaws or biases affecting your confidence may have personal roots. In this case, there is a near certainty that it does. As you dig through the performance issues, ask yourself questions about why your emotions are so intense, how they're connected to your past, and if they show up in your life outside of trading. Resolving the personal side of this problem is necessary to have any success, and of course, this book alone won't do that. Although sometimes hard to accept, an idea that has helped clients with this issue is thinking of themselves like an injured athlete. Some of you may have such a severe injury that you need to step away from trading to heal and work on the problem for days or weeks or longer. This amount of time is what it will take to build an understanding of what's causing it, and to personalize the strategy that I outlined below to prevent desperation from destroying your trading. 1. Maintain a sense of urgency. It's a major mistake to take desperation or the steps to correct it too casually. If you think that you'll wake up one day and the problem will be gone, you're delusional. Problems of this severity aren't fixed overnight. To have a chance of fixing this problem, it has to be your top priority. 2. Map your desperation. Map the greed, fear, and tilt that are the day-to-day issues that eventually lead to desperation. These details become an early warning system. Desperation is possible every single day you trade until you have proven that it's not. You have to take aggressive steps at these early signs, even though they might not turn into that big of a deal yet, to have any chance of preventing desperation. 3. Set strict daily stop-loss. Sure, you've probably set these before and blown through them, but that doesn't make it a bad strategy, especially since it's unlikely that you've combined a daily stop-loss with these other steps, meaning you had little chance to control the emotion that forced you to disregard it. A daily stop-loss is not just important to preserve capital, it also protects confidence and prevents it from taking too big of a hit. 4. Book wins. In normal situations, you want to keep your foot on the gas pedal. But in the early stages of correcting desperation, the losses that come after some big profits can be more painful and damaging than losses at the start of a day. Since overconfidence and fear can negatively impact execution after earning outsized profits, booking a win and shutting it down is a temporary crutch that you should use. You have significantly less to gain than what you have to lose from a mental and emotional standpoint. Greed might compel you to push too hard, driven by a desire to instantly correct your confidence problems. Or the slightest drop in profit might induce tilt and cause you to force entry into a marginal trade. These setbacks re-injure your confidence. Book a win to preserve confidence so that you can go into tomorrow with something to build on. Do it with tomorrow in mind. 5. Take regular breaks or use a timer. Maintaining emotional control throughout the session is critical. If greed, fear, or anger take over your ability to think, you're far more likely to succumb to the intense accumulated emotions that follows close behind. A timer increases the likelihood that you can disrupt and correct these problems. While this strategy is disruptive and may even keep you from trading your best, it's far better than the alternative. 6. Take aggressive action towards the early signs. To take action early, go through the steps in Chapter 9 to devise a real-time strategy to disrupt the problem and gain control of it. 7. Recognize small steps forward. Recognizing sessions where you make progress gives you a boost in confidence to keep you working hard. Remember, increased recognition or awareness, not emotional control, is often the first signal of progress. Desperation is a major problem, and eliminating it takes sustained effort over a long period of time. When small improvements go unnoticed, you might abandon a strategy that's actually working. 8. Release day-to-day accumulated emotion. In the early stages of containing and correcting your greed, tilt, fear, or confidence issues, you'll create a pressure cooker-like effect. You'll get better at containing the emotion during the trading session, but if you don't release it, several days can go by where you feel like you're making improvements mentally and emotionally, which you are, but then one day you'll snap, and it will feel like the emotion just came out of nowhere. Use the mental hand history at the end of every trading session to digest and release the emotion. This is especially important after days that sparked a lot of emotion, where you were still able to prevent desperation from setting in. Celebrate that win, but digest and release the emotion. Otherwise, your odds of blowing up tomorrow are greater. 9. Correct self-criticism. I have yet to work with someone grappling with desperation where self-criticism wasn't a massive problem. When your reactions are so out of line, it makes sense why they deserve criticism, but it doesn't help. You need to think practically about why you failed and why desperation occurred. Learn from it and improve your strategy. Keep working on the problem in a practical way. The faster you can do that, the more likely the next iteration of the problem will allow you to take another step forward. 10. Correct the fuck-its. When you're so deep in a hole, a common tendency is to say, fuck it, and try to hit a home run. What's the harm? If it pays off, you get the benefit of escaping hell today. But that might also reinforce the idea that you can pull off an escape like this again. That makes you less vigilant about the work needed to keep yourself out of such spots to begin with. Trying to hit a home run in such a compromised mental state is weak. You don't reinforce quality decision-making. Instead, you reinforce the option to gamble as part of your range. Sure, it's really hard to walk away with a loss, especially a big one, when you have capital you could use for your escape. But you have to think about tomorrow. What's the value of the capital and confidence you preserve for tomorrow? When you're strong enough to be able to take a loss and show up stronger the next day, you've got something to build on. The fuck-its may be fun and make for a good story when they pay off, but that's not why you're here, right? Before every trading session, review your strategy to prevent desperation as if rehearsing for an emergency that has a high chance of occurring. This keeps all the details of your plan fresh in your mind so that you're ready to act. Be especially firm on this after several days or weeks of success. Complacency in your preparation is dangerous. Realistically, you'll need to go through several market cycles or a minimum of 3 to 6 months before you'll have firm evidence that desperation is improving or no longer a problem. This is a major issue, and like having a severe physical injury such as tearing your ACL, the rehab is long, so buckle up. If you're serious about trading, you must tackle this problem, and your best shot may be working with a psychologist, therapist, or coach. You could even bring them this section of the book to further bolster your regimen. Gurdeep, a part-time trader from the UK, can attest to the time and effort required to correct desperation. Using the 10 steps that I outlined above, it took him around 3 months to see any progress, and another 6 months to prove that he could trade without blowing up. That was with my help. So on your own, it will be a challenge to say the least. Let's look more closely at how Gurdeep managed to get on the other side of desperation. When he and I started working together, he had been day and swing trading for 3 years without having made money. He had a mentor who described him as a good trader with a lot of potential who had to gain control of his emotions. Every month, even every few weeks, Gurdeep would go through a series of boom and bust cycles, making 10,000 and then losing it all back and then some. At any moment, a normal loss or the threat of a losing day could trigger a cascade of revenge trading, doubling down on losing trades, and raising his stake on subsequent trades, all in an effort to make money back and end the day green. Out of the gate, we worked on mapping his revenge, which was the big problem that could eventually lead to desperation. It took about a month and a few big blowouts to get a clear map, and another month before it was precise. Gurdeep really embraced the detective role, and mapping the details of his tilt immediately afterward proved to be a big eye-opener. Seeing every step on paper was a boost to his confidence that he could eventually beat this. Even though he knew the problem was going to take a lot of work, he had previously felt consumed and overrun by his emotions. Now he could see the emotions coming, and that was powerful. At this point, we established a zero-tolerance policy, deciding that if his tilt rose to level 3 on his scale, he had to shut it down for the day. That was the last point where he could possibly retain control without needing luck from the market to avoid a massive losing day. Over the next 2 months, the boom and bust cycles continued, but Gurdeep showed small signs of progress after each cycle. Sometimes the progress was a clearer understanding of the performance flaws or the personal issues causing the intense emotions. At other times, he was able to recognize the urge to get his money back and seek revenge, and instead quit the session. At the heart of Gurdeep's desperation lay personal issues of low self-confidence. Losing money was devastating and made him feel worthless. That was further reinforced by the self-inflicted losses that came from his lack of emotional control, and a growing sense that he was running out of time to make trading work out. For him, every trade felt like his identity and future were on the line. Add in a mixture of high expectations, intense self-criticism, and common performance flaws, and Gurdeep had a prototypical recipe for desperation. As we worked through the issues, the intensity of his emotions began to stabilize. We doubled down on that progress by tightening his routine. He would spend 1 to 2 hours on the simulator before a trading session to practice executing his strategy. During the session, an alarm would go off every 15 to 30 minutes to remind him to check on his emotional state and review corrections to his flaws. Then after every session, Gurdeep evaluated his process, looking for mistakes to improve and improvements to praise. When he tilted, Instead of getting angry at himself for tilting, he tried to understand why it happened and what was driving the anger. 7 months in, the cycles became less frequent and less severe, but Gurdeep continued to work the process. He'd take weeks off when personal issues added emotional volatility to trading that he couldn't control. He set realistic goals to ease back the time pressure. He continued to work on his confidence issues and understand more about what made him a competent trader. He maintained a strong commitment to his routine. All of that hard work paid off. Now Gurdeep's tilt is caused by flaws that are more normal among traders, like being too P&L focused or getting stopped out by just a few ticks. More important, he believes he can make it as a trader and is motivated to realize his full potential. Hope and wishing. After an intense section like desperation, you might read the title of this one and assume that I'm going to talk about hope and wishing in a positive, uplifting way. Well, the opposite is true. My goal for this section is to kill your hopes and wishes. Welp. To be blunt, there's no place for hope or wishes when it comes to trading, or any area of performance for that matter. Sure, there's a place for hope and wishes in other parts of your life, but in this environment, they're dangerous, undermine your confidence, and stunt your improvement. For those of you who routinely succumb to hope and wishes, it may be so common or such an ingrained part of how you operate that you may not even realize they're there. They come out at particular moments, showing up in isolated ways and giving you the impression that they don't affect you. Hope. Hope is an emotion connected to things we can't control. Hope can be a useful emotion in society, with so much of our lives affected by things outside of our control. We can hope for good weather when we host a barbecue or go to an outdoor wedding. We can hope our airplane lands safely and on time. But hope has no place in performance. Time and energy spent focusing on things you can't control are wasted, and they need to be redirected to places where you have the opportunity to improve your control, like on your execution or how you handle your emotions. Here are some of the ways that hope seeps into trading. Hoping that you don't get stopped out, that you'll reach your target, or that your loser will get back to break even. Babysitting a trade, hoping your presence will yield more profit. Hoping you have a great month, or that your results turn around. Losing hope that you can get over the hump and realize your goals. Becoming so hopeful about your own potential that you feel like your future has already been realized. At your lowest points, you may have felt hopeless. Essentially, you believed there was nothing you could do to achieve your goals. And you had thoughts like, I can't see how things are going to turn around. I should just quit. Or, no matter what I do, it's not going to make a difference, so why bother? You believe that you don't have control and that you never will. Your hopes have been dashed. To begin correcting this problem, think about the reasons why you turned to hope in the first place. For one, since it's so common in society, you may have assumed that it was okay here, or you might have deep doubts about your ability to succeed. Rather than deal with those fears about your incompetence, you automatically turn to hope as a way to manage that. Start by identifying where hope exists and ask yourself, what is it protecting? Basically, what do you not feel in control of, and why not? Then, as I sometimes joke with my clients, fuck hope. It's that simple. Putting energy into something you can't control, or worse, giving up control in spots where you need it, is dangerous. Even though it's small and seemingly innocuous, what happens when what you hope for doesn't happen? Whatever it was that hope was protecting gets exposed, like ripping off a Band-Aid. Immediately, your lack of control becomes obvious. Higher emotional volatility as you overreact to losses, mistakes, and setbacks. Or if what you hope for materializes, you assume control of more of those big wins. In a larger sense, when you rely on hope, you're not controlling all that you actually could control. Like a lot of things, the first step is awareness. If you have confidence issues and by this point haven't figured out what's causing them, or if you're missing something in your analysis, hope may be affecting you in a subtle way. Wishing. Identifying the wishes that are hidden in your mind is critical. Wishing not only causes instability in your confidence, but also negatively affects your ability to correct the flaws, biases, and illusions already impacting it. Wishes such as an ability to always perform at your best, know the direction of the market, or learn easily, are usually harbored deep in the recesses of traders' minds. Surprisingly so. Many traders are stunned to realize their confidence is affected by wishes like these. They're illogical. That much is obvious. And yet, as impractical as they may be, many traders have them. It's one thing to want to always perform at your best, know the direction of the market, or learn easily, but it's quite another to wish those outcomes could be real. When you have wishes such as these, it means you actually believe they're possible and hold out hope that one day they could come true. Why would you work as hard as you could to improve as a trader when deep down you believe you could predict the direction of the market? Why would you be open-minded or try to learn about the mental game if you believed your emotional problems could be corrected easily? If you believe your wishes will be granted, it would be illogical to work hard. Since spotting these wishes is tough, try this process that I go through when I'm working with a client. First, take a few deep breaths to relax your mind and suspend logical thinking. Logic believes these wishes are absurd and will deny their existence. Put that part of your mind aside for a moment and allow your gut to react to the following questions. Answer them as honestly as you can. Do you wish that variance wasn't part of trading and that you could make what you deserve? Do you wish that you could have perfect discipline and always execute your strategy correctly? Do you wish that you had the perfect method, system, or indicator that would allow you to print money? Do you wish you could have masterful control of the markets and make millions? Do you wish you could make money every month, every day, or from every trade? Do you wish you could watch a video or read a book and be able to instantly apply all that you have learned? When in a big hole, do you wish for one trade to get you right back to even? Even if you don't wish for any of these directly, as you read them, does a part of you think any of them would be cool outcomes? Your answers will range from a firm no to a resounding yes, or somewhere in between. Wishing isn't a black and white thing. Wishes show up in matters of degree. Regardless of how small they appear, correcting them is vital to developing stable confidence. Wishes are hard to eliminate. They're like a stubborn mule that won't budge. The more you try to force them to go away, the more intractable they become. Force won't cut it. This should make sense, as you're essentially trying to wish them away. Instead, you need to get to the heart of the wish and resolve it. To make working through this process easier to conceptualize, here's a story of a trader whom I worked with who found that a wish was surprisingly at the heart of an issue he had with FOMO. Nick is an aspiring full-time trader from the UK. When he and I first worked together, he was an office worker in local government, but due to the coronavirus pandemic, he was able to trade for an hour when the US market opened. Here's what Nick described in steps 1 and 2 of his mental hand history. 1. What's the problem? I don't want to miss out on the opportunity of the day. So when I do, I want to make it back somewhere and begin searching for a trade that will make the money I should have made. That FOMO can even carry over to the next day. I get hyped up and go into the day thinking, this is going to be a big day. But I instead end up with massive losses. 2. Why does the problem exist? On days where the opportunities are there and clear, I should be good enough to take them. I also look back and see that my plans are working, even if I haven't traded them well. I realize that hindsight trading doesn't make sense, but I expect the market will provide the same opportunities again the following day, and that those next trades will be winners. When he said, I expect the market will provide the same opportunities, I sensed there might be a wish behind such a statement. I asked him to do a gut check, to take a deep breath, shut off the logical side of his brain, and allow his gut to answer if he wished the market provided the same opportunities each day. He immediately said yes, and added that he also wished that he could trade perfectly and go on a big win streak that would never end. We continued with those wishes as the new first step in the mental hand history. 1. What's the problem? Part of me wishes the market could provide enough good opportunities each day that I could trade perfectly and go on a big win streak that never ends. 2. Why does the problem exist? If the market gave me perfect opportunities and I traded them perfectly, then I would catch all the big moves and that would prove I'm successful. Leaving money on the table when the market leaves it there for me says that I'm behind everyone else who is able to take advantage of the day and that I need to make up for that. 3. What is flawed? Opportunities are easy to see in hindsight. I often look back on a chart and think, that was the most obvious thing. But it's only obvious when you already know what's going to happen. That doesn't mean that I'll be able to see and take them in the future. What I'm really looking for is to eliminate the doubt or uncertainty that I'm profitable enough to make it as a full-time trader. Working through the layers of this problem, you can see that Nick's FOMO on the surface was actually caused by deeper concerns about his ability to make it as a trader. When nailing down a correction in steps 4 and 5, it was important that it corrected both the FOMO and the wishes. Here's what we came up with. 4. What's the correction? It's okay to have uncertainty. That's an inherent part of this game. Continue to learn and develop your competence, and that will allow you to capture more of the opportunities, but never all of them. 5. What logic confirms that correction? I can't be perfect, and trying to be puts my dreams at risk. For Nick, the biggest benefit of the process came from realizing how silly these wishes sounded. He prides himself on being a logical thinker, and having to admit that he was invested in these wishes made him quickly realize how unrealistic they were. This immediately removed some of the pressure to be perfect, and his work around trading became more efficient, such as focusing on screenshots and journaling. Additionally, his view of the market and how he needs to operate became much more realistic. Perfect patterns rarely present themselves the way Nick wished them to, and letting go of this wish allowed him to recognize the edge he was previously missing by trying to be perfect. He also became a lot better at spotting those moments where a wish would pop up. For example, a reaction like, I should have been able to take this. As a result, he could focus more on what was actually realistic. The more he did that, the more comfortable he became with what was realistic and unrealistic, and that further decreased the power of those wishes. Plus, he stopped daydreaming about unrealistic situations, freeing him up to see opportunities in the market without a false narrative that had plagued him before. Such wishes can never come true. Believing in them is no different than believing Santa Claus delivers presents to millions of kids in one night. Instead, change your wish into a realistic goal and come up with a strategy and plan. Look for the subtle or not so subtle ways in which wishes hijack your efforts and correct them in real time. As you work that process steadily over time, your confidence will become more stable, and you'll notice how much easier it is to be at your best. No matter where your confidence problems stem from, you now have a good understanding of how to create stable confidence in your trading. As this aspect of your mental game improves, so will your ability to be consistent in your decision-making. Now that you've learned how confidence as well as other primary emotional problems can interfere with your trading, it's time to dive into discipline. We couldn't take a closer look at this problem until you had experience teasing out the effects of greed, fear, tilt, and confidence on your execution. But at this juncture, you're ready to see if any discipline problems are holding you back. That's coming up in Chapter 8. Chapter 8. Discipline. Talent without discipline is like an octopus on roller skates. There's plenty of movement, but you never know if it's going to be forward, backward, or sideways. H. Jackson Brown, Jr. So far, I've covered the emotions that cause problems you previously thought were due to a lack of discipline. You now understand that emotions compelled you to trade against your strategy. For instance, by forcing a mediocre entry, jumping into a sideways market, or impatiently closing out a trade before you hit your target. You've learned that your attempts to remain disciplined weren't going to work. A lack of discipline wasn't the problem. Powerful emotions were the problem. If you've taken steps to correct the flaws that lie beneath those emotional issues, you're ready to take on any actual discipline problems that remain. If you've come to this chapter directly, or if you're unsure if you've made enough progress correcting your emotional issues, don't worry. You'll get feedback pretty quickly on whether the issue is related to emotion or discipline. If you make good effort to use the advice in this chapter for 2 weeks of full-time trading and you don't make progress, the odds are high that you need to address the underlying emotions first. Or if you only make temporary progress, but quickly slip back into old habits, you need to prioritize correcting your emotions alongside the advice in this chapter. If you're unsure whether or not you're ready to take discipline head-on, make your best estimate and the feedback will tell you whether or not you're ready. For some of you, achieving emotional resolution has already led to automatic improvements in discipline. Essentially, you had the capacity or skill to be disciplined, but it was hidden or impaired by those emotional issues. Once they were removed, your capacity for discipline sprang to life. But for others, resolution is like building a house in a forest. Resolution comes in and clears the land, creating space to erect new habits. But you still have to get in there and build the house. It's not like all of a sudden when the ground is cleared, you have a beautiful house to live in. You need to build your discipline from the ground up in the newly created space. For help in building discipline, there are a ton of general resources out there, such as The Power of Habit by Charles Duhigg, Atomic Habits by James Clear, or the Stephen Covey books. This subject is widely covered by experts who specialize in developing structure and discipline, and the advice applies well to traders. In addition, the general framework for what makes a disciplined trader has already been pretty well defined. I'm not going to talk about that structure, or tell you to do a trade journal, track your trades, or analyze your charts, for instance. But if despite knowing what you ought to be doing, or having read resources like the aforementioned, you continue to lack discipline, something is missing for you. What I provide in this chapter is some advice on how to tackle the problems preventing you from establishing the consistent habits you know will enhance your trading, and maybe even think about discipline a little bit differently. Discipline is not a one-and-done deal. You don't just become disciplined. It's not a static achievement that's accomplished once. I'm disciplined! And then never thought about again. Neither are you someone who's either disciplined or not. That's too basic an analysis. All of you, right now, are disciplined. Everybody has their own degree of discipline. It's impossible to be at this stage of your life without having some of it. You have areas of strength, regardless of how weak they may be compared to other traders. Maybe their discipline C game ranks above your discipline A game, but you have to look at it through your own range. You must establish where you're currently weak to make progress. Discipline follows the inchworm principle. You have both a range and an opportunity for continual growth. The definition of an optimal level of discipline changes as your goals change. But for a lot of traders, there's a large gap between where they aspire to be and where they are now. This chapter is designed to help you eliminate your current discipline C game and narrow your range. Your ability to be at your best is linked to how strong you are when you're weak. Being stronger, or sucking less, at those times when it's easy to slip back into your discipline C game is essential to becoming more disciplined. That perspective should motivate you. You don't have to focus on becoming disciplined like it's a personality trait, but instead you can pinpoint specific habits at specific times to improve. As you build those habits, becoming more disciplined in executing your trades and the actions around your trading, you create an internal process that's built for growth. Discipline, however, comes with a cost. There's a freedom that comes with trading, especially for traders who work independently. You get to participate in this worldwide marketplace with massive opportunities. Obviously, there are rules to how the industry operates, but there's open runway to make it what you want for yourself. Discipline runs counter to that idea, and it can take away some of that excitement. It can make discipline feel like more of a chore rather than the thing that unlocks your potential. In some respects, traders are like artists. Artists usually don't like constraints either. They want to be free to unleash their creativity in whatever ways their instincts or intuition guides them. But artists need tools to create, paintbrushes, chisels, etc. And their creativity is bound by their ability to use those tools. Developing their technique in the use of those tools unlocks their creative potential. In the same way, discipline is a tool that you use in trading, and if you're not continually upgrading your abilities with that tool, your potential is capped. Nature of discipline. Discipline comes from a combination of mental strength and willpower. Your mental strength comprises the muscles, and your willpower the energy that fuels them. While mental strength is a concept that gets thrown around a lot, it often lacks a strong operational definition. Mental strength is the strength of your connection to an idea, concept, or belief. Mental strength isn't some esoteric, intangible idea. We can evaluate it much like an athlete would assess their muscular strength. How well does their body hold up under the conditions of competition? Where is it strong? Where is it weak? Where does it break down and fail, and why? At some point, your muscles will eventually weaken or fail, in competition or doing hypertrophy training in the gym, and that gives you an indication of your current capacity. In the same way, when you look closely at the breakdowns in discipline, examine the ideas, concepts, or beliefs that fail to hold up in your mind. Then try to determine what makes them weak, what flaws might exist, and what ideas might be acting against them. Think about the people that you believe are mentally strong, and consider the ideas that most deeply personify that strength. Perhaps someone is devoutly religious. They have an intense connection to the religious doctrine they follow. How about a U.S. Navy SEAL who lives by the creed that, if knocked down, I will get back up every time. I will draw on every remaining ounce of strength to protect my teammates and accomplish our mission. I am never out of the fight. Or the athlete who believes they can win no matter what, even against insurmountable odds. These ideas are so deeply embedded in their mind that they hold up under the most intense circumstances and make that person mentally strong. In trading, consider the idea of preparing for the trading day and properly reviewing it afterward. This is part of a daily routine that you intellectually know is important. But how strong is the connection you have to it? Does it hold up on days when you've slept poorly or tilted? How about after big winning or losing days, or in an extended drawdown, or after months of consistent profits? Those situations challenge the degree to which the importance of a daily routine is strong in your mind. When you have a rich understanding of the value it provides, the consequences for half-assing it, the steps to completing it, the methods of adapting it, and you have practiced enough to master it, there is such strength behind the routine that it happens automatically in those situations. You can't help but do it. That's just how you operate. Common signs of discipline problems. Many of you already know the instances where you lack discipline. Think about the times when you failed to follow your daily stop loss, to take a break to reset when you're bored, or log your trades at the end of the trading day. Worse, you're aware that you should be doing these things, but you can't will yourself to do so. You force trades even when you know there's no opportunities. You get in sooner than your strategy tells you to, and you get sucked into looking at other markets outside of your strategy. You trade just to trade. Lacking the will to do what you know you should do is the most notable sign of a problem with discipline. Willpower is the name for the energy you use to be disciplined. Unfortunately, like physical energy, willpower is a finite resource. When you're running low on willpower, you lack the energy to power your mind and maintain discipline. Your willpower isn't just affected by trading activities. Your lifestyle can drain you as well. Much like athletes organize their lives around training and competition, you may need to do the same thing in trading. Make trading the center point of your life, so your energy and willpower are at peak levels when the market is open. You don't need willpower to be at your worst. You do that easily. Willpower is the energy you deploy to build the habits, routines, and processes that build strength and improve discipline. This should be freeing. Sometimes willpower is talked about in an all-encompassing way, like you're someone who just lacks willpower. But in truth, we all have it. The question is, are we able to use it in a precise way? When it comes to trading, decisions themselves cause fatigue. Every decision burns energy, and eventually you can run out. Think about the periods of time in a day when you lack the energy to properly think. It becomes easy for your mind to wander. You spend too much time on Twitter. Start looking for opportunities outside your strategy, or think about plans for the weekend. Steve Jobs' famous turtleneck and jeans wardrobe wasn't just about branding. It was an energy saver. He made one less decision each day. Energy is finite, and while there are ways of replenishing it during the trading day, preservation can sustain disciplined execution. Ultimately, you only want to use the amount of discipline that's necessary to achieve your goals. The traders who overwork themselves and repeatedly burn out could arguably be excessively disciplined. That workload is not only counterproductive for trading, it can suck the life out of your life. Resentment builds and decreases your longevity in the profession. You don't want to be more disciplined than you need to be. Many of you are here because you don't have enough, but it's not black or white. Where do you need it and in what way? Get precise, because like any other problem, the details matter a lot. Lastly, it's important that you distinguish whether discipline is breaking down because of emotions or a lack of willpower. If you're unsure, here's a simple question to ask yourself in moments when discipline breaks down. Are your emotions too high, or is your energy too low? If your emotions are too high, it's not a discipline problem. Emotions do put pressure on your work habits, but they do so in ways that I talked about in chapters 4 through 7. If, on the other hand, your energy is too low, you're in the right place. General strategies to improve discipline. Traders often wish they had more discipline, but are unprepared to build it in a sustainable way. The biggest opportunity to improve your discipline actually happens at the times when you're weak and more likely to fail. Maybe you're weak in a certain type of market, entering a particular type of trade, or at a specific time of day. Regardless, you need to be ready to take advantage when the opportunity arises. In addition to the advice unique in each of the 6 discipline problems addressed later in this chapter, here are some general ways you can improve discipline. Take full responsibility. The first step to becoming more disciplined is to acknowledge that your success in trading is entirely on you. You're the only one responsible for your goals, decisions, time, and work ethic. If you rely on external things, make excuses, or hope someone else or some event will drive your success, you'll never reach the level of discipline you aspire to. Even if you work in a firm or a proprietary shop, success is still ultimately in your hands. Regardless of your reporting structure at work, You're effectively your own boss and need to behave that way. Sure, you could argue that that's not actually true in an office setting, where you report to someone who limits your risk and the types of trades you can make. Except you chose to take a seat there. You make important decisions, and you're to blame if anything goes wrong. So it is true. You're still your own boss, even if you don't get to make all the decisions. Think of it as having set up your own shop in their office. The reason you may shy away from this idea is because you feel less pressure when someone else is running the show. The ultimate responsibility is on them, not you. Knowing you alone control your fate can feel like a heavy burden on your shoulders. Sometimes it just becomes too much to bear, and discipline problems are an attempt to relieve some of this weight. Taking responsibility isn't just about making that declaration. You need to understand clearly why you give up responsibility in the first place. Not surprisingly, there are often unknown factors and influences that undercut your efforts. You need to tease them out so they can be corrected. Quick tip. Review the ways in which your discipline breaks down and write down the benefits of breaking your rules. The idea that a breakdown in discipline could be beneficial can sound strange, but our actions always serve some benefit. Going through this exercise can make you more aware of why you're willing to let go of your responsibility for your own discipline. Increase mental strength and willpower. Break out of the idea that you either have discipline or you don't. You have it, you just want more. A big part of how you develop more discipline comes from increasing both mental strength and willpower. As I mentioned earlier, mental strength is the muscle behind the rationale for your habits, while willpower is the energy that drives the repetition needed to form those habits. By pushing yourself to be more disciplined at times when it doesn't come easily, you can increase your mental strength and willpower. The process is simple. In the moments when you have the option to succumb to the weaknesses in your discipline, push yourself to do better. At the same time, reinforce the rationale around the habit. If, for example, you consistently fail to log trades, go through your pre-market routine, or analyze charts, start with the minimum amount you can possibly do. It doesn't matter if it's as pathetically small as 1 minute. Choose the minimum you can do consistently, under any circumstance, no matter what, except during random emergencies. Even when you're tempted to give up, think about your goals and push yourself to take steps towards them. Sometimes just making a little progress can be transformational. Obviously, you can do more than the minimum if you get on a roll. Over time, as the habit gets stronger, you can scale up and work on making your small actions automatic, and then use your discipline on the next habits. This is not something you can do in a day. It requires consistency. If you fail to maintain that consistency, you're instead ingraining bad habits, making good ones harder to establish. Quick tip. Traders often make the mistake of aiming for levels of discipline that are beyond the front end of their inchworm. That's like going to the gym and trying to bench press 200 pounds when you can only lift 150 pounds. While not beyond the realm of your potential, it's not realistic yet. Start with what you can do and improve upon it. And be sure to reinforce the progress that you're building, not what you're still lacking. Otherwise, self-criticism will slow down the process of building greater discipline. Use, don't abuse, inspiration. Inspiration is a tool. When used in the right way, it can assist in developing discipline. Use it incorrectly or abuse it, and you'll perpetuate the same problems that brought you to this chapter. In order to avoid making that mistake, let me explain some background theory first. Although you may consider them to be one and the same, there's a significant difference between motivation and inspiration. While each plays an essential part in developing discipline, motivation is like a marathon runner, and inspiration is like a sprinter. Motivation is a more stable energy that keeps you consistently working over the long term. Inspiration is high energy, and it provides short, intense bursts of energy needed to get you fired up or to stay on track. Inspiration isn't what's going to allow you to consistently train yourself to adopt all of the habits you need as a trader. For that, you need consistent and stable energy to keep you motivated over the long term. We all have habits that have become automated, some of which we call bad habits and attribute to a lack of discipline. Training to that degree, however, doesn't differentiate between good or bad. It just knows what it has learned to the point of automation. Overtrading, constantly checking P&L, or getting distracted by social media are habits you're really competent at, even if you consider them bad. You abuse inspiration if you rely on it to change these old habits. If you need a daily intake of things to fire you up, such as challenges or bets with other traders, watching clips of The Wolf of Wall Street, or new trading courses, you're compensating for an underlying problem. Inspiration makes you feel like your bad habits are gone, but eventually they return because you didn't upgrade or correct them. Inspiration is best used sparingly and just as an extra boost when you're most likely to fail. It's like the personal trainer egging you on to get in those last reps. If you need a trainer to even get you to the gym, you have a deeper problem with discipline that inspiration can't fix. That could be your way of trying to manage any of the discipline problems described in this chapter, or it could be your way of dealing with fear or a confidence problem. Quick tip: if you're going to use inspiration, plan out the specifics in advance. You don't want to search for something to inspire you when discipline is falling apart. Be prepared with the music, movie clips, quotes, videos, catchphrases, etc. Whatever can quickly and reliably inspire you when you need it most. Mapping where discipline is needed. The ability to increase your discipline must come from a realistic assessment of your current strengths and limitations. Remember, it's not black and white. Regardless of whether or not you think of yourself as someone who is mentally tough, strong, gritty, or has good willpower, you're missing the point. Inchworm teaches us that we still have room to improve. Completing the discipline mapping will give you a good picture of the work you need to do. From there, you get to define the workout, the places where you're weak and can get stronger. The following steps will help you create a document that will become the map of your current level of discipline. Step 1. Start by writing out a short description of what ideal or optimal discipline looks like for you. Think about the instances where you've demonstrated it. Be specific about what that means in terms of your routine, motivation, focus, energy, executing your trading strategy, and the actions you take around trading. A written description not only provides clarity on what you're striving for, creating one makes it easier to recognize the subtle signs that discipline is breaking down. This is critical. Regaining discipline is always easier when the problem is small. Here are some questions to help you think about what it means for you to be optimally disciplined. What's unique about your decision-making process and execution? How do you manage the ups and downs in P&L? Describe your focus, motivation, and energy. Describe what you do at the start and end of both the trading session and the day. Under what conditions do you have it? If you've never attained that level of discipline, what realistically is your current peak? Step 2. Over the next few weeks, pay close attention to breakdowns in discipline. Examine and capture the signals of a breakdown, including thoughts, emotions, things you say out loud, behaviors, actions, changes to your decision-making, changes to your perception of the market, opportunities or current positions, trading mistakes. Keep a document open on your computer or a notepad next to you while you trade and take notes throughout the day. At the end of the trading day, review what you found and add additional details. Be as comprehensive as you can. And remember, times when you lose discipline are great for identifying what's happening and understanding why. Here are some questions to help you get started. In what ways do you typically lose discipline? Impatient, bored, distracted, lazy, etc.? What are the things that you do instead of what you're supposed to be doing? How frequently does it happen? In what situations do you most likely lack discipline? Do problems occur more when you're winning or losing? In certain types of markets? At the beginning, middle, or end of a session? After or before trading sessions? How impactful are fluctuations in sleep, diet, and exercise? What excuses do you make for instances when you lose discipline? What's the first sign that discipline is breaking down? For example, you can't sit on your hands. You know you need to just walk away, but you remain glued to your screen, watching P&L fluctuate, and looking for more trades to take. Or when volatility dries up, you get bored and start looking at social media, but you miss opportunities that still present themselves. Perhaps after a rough losing session, you don't sleep well, and the next morning you look over your pre-market data too quickly. The combo of less sleep and poor preparation lead you to enter impulsively, chase price, and take random trades outside your strategy. Keep an eye out for signals and patterns like these. And remember, mapping discipline is an iterative process. When you spot new details, even just slight adjustments, be sure to note them. Small details matter and can make all the difference when the opportunity to make progress is on the line. Step 3. Once you've gathered a lot of details, organize what you found by listing them in order of severity in a document, where 10 is optimal discipline and 1 is your worst level of discipline. At each level, Identify details that clearly distinguish it from the other levels. As you assign levels of severity, split them into two categories: the mental and emotional side of discipline and the technical side. They sit side by side, so for example, level 10 on the discipline side corresponds to level 10 on the technical side, and so on. You don't need to have details for all 10 levels, however. Most traders whom I work with aren't able to distinguish their levels of discipline to that degree. Do as many as you can, but do a minimum of 3. Then take the details you've categorized and put them into a map like this. Discipline level. Describe the thoughts, emotions, things you say, behaviors, and actions that highlight each level of discipline. Complete at least 3 levels. 10. Energized, totally consumed by the process, waiting for the market to come to me, not concerned about money. 8. Wondering why it's not working and trying to convince myself that it still can. A bit on edge, leg bouncing. 5. Heart rate accelerating, moving the mouse faster, care what other traders are thinking, and looking for something newsworthy. Thinking about how to end the day green. 2. Can't step away, even though I know I should. Checking P&L every 10 minutes. Body feels itchy. Technical level. Describe the quality of your decision-making, perception of the market, opportunities, or current positions at each level of discipline. 10. Taking action only at my predetermined spots and able to let the trades play out. 8. Have trouble letting go of losing positions and looking to enter new spots sooner than my strategy tells me to. 5. Forcing trades for valid reasons, but not my ideal. 2. Overtrading, getting in and out of positions more randomly, moving my stops. In this example, impatience is the primary problem. However, if you have multiple discipline problems, you can include them on a single map. Now you have a starting point to dig into your discipline problems, so you can identify the cause and devise a strategy to move your C game forward. Impatience. Impatience comes in different sizes and exists on both a micro and macro level. Think about how you feel in a drawdown and when lacking opportunity in the market. Maybe you get tired of waiting and can't sit on your hands anymore. The itch to fire off a trade is so strong that you find an excuse to justify a mediocre one. Or you have trouble watching a position as it closes in on your target. The up and down ticks drive you crazy. You want it to hit your target now. You're like a sports fan sweating the back and forth of a tight game, and you close it prematurely just to kill the tension. Perhaps you make decisions too quickly. You see a flurry of activity and want to jump in. You don't take enough time to properly manage risk, and then you overreact to a move in the market and end up chasing it. All of these are signals of how impatience presents itself on a micro level in your day-to-day trading life. You may be well aware of impatience on these micro levels, but not recognize it on a macro level. You can be impatient with lulls in your career, or itching to make a lot of money really fast. You can be impatient with the learning process, effectively wishing that you could learn things instantly, or far more rapidly than is realistic. Or maybe you can't tolerate a new strategy or system's inevitable drawdowns, so you're constantly searching for a new one. Other signs of impatience on a macro level include believing that you can make opportunities appear, a version of the illusion of control, an inherent distrust or uncertainty around your overall strategy, and losing sight of how you make money. All of the emotional issues we have covered in this book are large contributors to impatience, most notably greed, FOMO, and tilt. You simply can't sit on your hands, allow the trade to play out, or properly consider all the key factors when making a decision, because the emotions build up like a pressure cooker and you feel compelled to act. When addressing impatience as a discipline problem, you're not going to become patient by forcing yourself to be patient. Patience is a byproduct of working the process. When you have a firm grasp of process, whether it be building a career, executing a trade, or correcting a mental game issue, you're automatically patient. Provided there are no underlying flaws that alter your perspective on that process, impatience ceases to be a problem. The reason why this is so important is because when someone has told you to just be patient, they're advising you to slow down and take your time. That's not what you should be doing. What you should be doing is moving as fast as possible while maintaining the process necessary to be successful. Imagine an assembly line moving too fast and the final product ends up with missing or broken parts. On the other hand, you don't want the process to move too slowly either. That assembly line needs to meet its quota. When impatience causes a breakdown in your decision-making process, the solution isn't simply to slow down, but to train yourself to automatically consider the pieces of your process that typically go missing when you're impatient. For some of you, that's impractical. You have too much discretion in your decisions. But the places where impatience shows up could still be an indicator of a hole or weakness in your strategy. For instance, you may not know all the reasons why what you're doing is right or wrong, and this leads to impatience. Ask yourself, why do you feel this need to move faster? What's pushing or compelling you? If it's a purely competitive drive, maybe you're not actually impatient. Maybe that's just a criticism you hear from people who aren't as motivated as you are. Another reason could be that you wish skill or competence could be acquired instantly. Outwardly, you may be committed to the learning process, but deep down you wish you didn't have to go through all the ups and downs that come with it. Sometimes traders are so driven to succeed and make a lot of money that they aren't thinking about longevity and building a solid base of skill. But think about it. Do you want to be a flash that comes out of nowhere, makes a ton, and then has a high risk of losing it back? Or would you prefer the lower risk route, where you consistently build an edge in the market over the long term? Sometimes traders race for financial security without realizing that security also comes from developing a process that creates and maintains an edge in the market. Boredom. Boredom is a signal of the absence of opportunity, either the opportunity to execute trades or the opportunity to learn and develop. Or you're burned out and lack the energy to focus as you would normally. From the execution side, being bored could indicate that current market conditions are unfavorable for your strategy or system. In that spot, your mind will turn off or go flat. You'll feel unenthusiastic about anything you see and should scale your expectations appropriately. The problem is, instead of a scale, your mind only has an on-off switch. In that situation, it's easy to overreact to the size of the drop in opportunity. A 50% drop in the number of opportunities suddenly feels like nothing is happening, and you shouldn't even be trading. As a result, you miss trades because your mind lacks the interest in finding them. It's hard to calculate the cost of these lost opportunities, but they exist, and you need to keep your mind sharp enough to capitalize on them. Yes, you may not make as much as you would have in a normal market, but isn't something better than nothing? Isn't what you could make now ammunition for when conditions turn and you could capitalize on it more? From an execution standpoint, it's easy to overreact and think there's nothing you can do. You're physically there, but mentally on autopilot. The key is to shift your mentality from that of a starting quarterback to that of the backup quarterback. Assume there's opportunity and you just need to be ready. Remember, assuming there's nothing you can do is a form of thinking you know what's going to happen, and you don't. For some, this requires developing a new level of focus or mental activity. You need to look at it as a skill and train it. First, write up a clear description of what readiness looks and feels like for you. For example, having a strong, engaged level of energy that's not overly intense and being present without being detached. Then, when a moment of boredom strikes, challenge yourself to figure out how you can achieve a greater edge in this type of market. What are the little things you can do? Focus on what keeps your mind active. Market cycles like this will continue to happen. If you find ways to improve cycle over cycle, you'll find the antidote to boredom. You can't change the market, but you can change how you operate in it. This advice proved helpful for Michael, an energy trader from the US who started his own fund in 2004. He ran into periods of significant boredom every few years. Before he and I talked, he mistook these for periods of burnout, and he'd take 2 to 6 weeks off to decompress. He'd come back refreshed and go on to crush it. After years of tremendous success, however, Michael noticed that something was different. Instead of taking a vacation, what he wanted to do was quit. Days that had once been busy, dynamic, and packed with action now felt boring. Part of it was due to the market. Around 2014, the volatility and liquidity in the natural gas market dried up, and it truly was less busy. He went from 100+ trades per day to 20. There was less opportunity for risk or reward, and Michael started to wonder if he should get out. It turns out, however, that what was silently killing his passion for trading wasn't the reduced opportunity. It was an assumption that nothing was going to happen. Michael was showing up physically, but mentally he would give up if there weren't plenty of opportunities right out of the gate. Talking through it, Michael recalibrated his expectations. Sure, an 80% reduction in the number of trades per day was significant, but 20 wasn't zero. He committed to making a serious and conscious effort to participate in the first few hours of the morning, and then, if nothing was going on, he could call it a day and work on other things, such as charitable pursuits or other investments. With that effort to participate came a renewed sense of pride and satisfaction that can only come from working hard. And soon he remembered that he still loved trading. But what sustained this progress long-term was recognizing his effort. Michael rated himself daily on the following dimensions: how hard he worked, quality of energy, level of interest in the market, the effect of outside emotions. The daily repetition built up a strong sense of accountability and responsibility. Even if the results didn't pay off that day, Michael felt better about himself and his performance when he knew he was putting in the total effort. If he was thinking and engaged, that made him feel productive, and he ended the day happier no matter what the result. Boredom leads to overtrading. Other traders react differently to sideways or uneventful markets. Boredom signaled them to overtrade. In this instance, the line I hear frequently is, "My job is to trade, so not trading just feels wrong. Sitting on my hands doesn't make sense." This is typically caused by a subtle fear that makes boredom a threat to your trading operation. Or it's driven by a need for action that comes from overconfidence or mild desperation. If boredom cues your mind to overtrade, you need to dig into the reason why. Does your mind go into overdrive? Are you worried about how long this market will last? Why you're the only one not making money? Or how it will affect your goals or your bonus? If boredom brings up these questions, it's not a discipline problem. It's linked to fear, and you'll find your answers in the fear chapter. Overtrading can also come from overconfidence. The illusion that you can control your results and force profits, as well as a need to always have positions on, is a sign of desperation or lack of confidence. Review Chapter 7. You can also use periods of boredom to correct the weaker parts of your decision-making process that lead to mistakes like overtrading. Figure out the specific ways that your decision-making process changes, and when you become bored, train the correction. For example, thinking about the context of the market as a whole. If that's a consideration you don't think about when bored, training to do so will allow you to eventually think about it instinctively. I'm not suggesting that you can automatically have a perfect understanding of the market as a whole, or that you're automating your decisions. I'm suggesting that you can upgrade the process for how you make decisions by training yourself to consider factors that you fail to see when you're bored. The net result is that it becomes easier to avoid overtrading. Believing there is nothing to learn. Boredom can also signal a perceived lack of opportunity to learn and develop. But guess what? There's always an opportunity to learn. In these moments, you just lack the clarity for what that means. It's easy to lose sight of what you're trying to improve on and be too lax in adapting your strategy to a market like this. Boredom happens because you're not challenged. Trading in a market like this may be easy for you. In that case, boredom is a signal that you have extra mental bandwidth that can be used productively. You could use it as an opportunity to look at aspects of trading that you wanted to work on but put off. The dynamics in trading are varied and constantly changing, and that's a big reason many of you love it. Every day is unique. There are always new areas in which to develop an edge. Trading is always evolving, and there's always more to learn. Figure out how to use your extra bandwidth. Bored when burned out. Boredom might be a signal that you're burned out, and if you are, the only correction is an extended break. Burnout can be easy to miss. You may think that you're being lazy, or making excuses for why you don't have the energy you usually do. What you need is a way of distinguishing burnout from these other discipline problems, like laziness, by finding some key markers. You can't just blindly keep pushing yourself. Burnout is a bit like a burn to your skin. There are matters of degree, and the worse it is, the longer it takes to recover. One of the biggest indicators of true burnout is being tired of the repetitive nature of trading, where it just feels like a chore. You've lost the excitement and interest you usually have for it. Whereas if you're being lazy, you're more likely to make excuses and spend your time elsewhere. For example, when you're lazy, you have no problem trading. That's still exciting. But the idea of researching or analyzing trades sounds painful. But when you're burned out, the whole thing is just overwhelming or seems boring. To be clear, burnout is not permanent and it's not bad. I'm actually a fan of pushing yourself to the point of mild burnout because it means you have hit your own limitations. If you never get burned out, you don't know how much more capacity you have left on the table. Being able to recognize the signs of burnout, like boredom, is an important skill. It allows you to work as hard as you possibly can and then know when to back off. Being overly results-oriented. Obviously, results are important, but problems arise when an excessive focus on results causes your process to break. You end up focusing too much on intraday profit, locking in winners too early, looking for outsized profits, ignoring your own rules, and/or trading outside of your system or strategy. Usually there's an emotional reason for this, but from a discipline standpoint, you may just believe that results are all that matter. Ultimately, your success is determined by the amount of money you make, and when your results dominate your intraday focus, it's easy to lose sight of how you make money. It's a distraction. You're distracted by the shiny object that's your P&L. You disregard elements of your decision-making process, like risk management, and take trades with a smaller edge or even no edge at all. You jump into new markets without considering your lack of experience. You ignore the process. Result and process goals work together. Result goals are the end point. Process goals determine how you'll get there. A terrific example of how they work together is how the United States came to land on the moon in 1969. Against the backdrop of tremendous political tension between the US and the Soviet Union, President Kennedy sought a challenging but achievable win that the US had a solid chance of completing first. In 1961, he set the goal of landing on the moon before the end of the decade. Prior to his announcement, most scientists doubted it was feasible. But with the stakes raised, the scientific community, government, and private industry needed to figure out how to make it happen. How do you build a spacecraft capable of landing on the moon and returning to Earth? How do you train astronauts to navigate in space? How do you get the 400,000 people who eventually worked on the project to work together? These and thousands of other steps, or process-oriented goals, pave the way to get mankind to the moon and back. Elevate your focus on process and how you'll attain the lofty goals, albeit less lofty than Kennedy's, you want to attain in trading. If you're overly results-oriented, one reason could be that you lack clarity around the process by which you'll attain them. For example, nailing down a consistent decision-making process, creating a strong pre- and post-market routine, and reducing tilt. These types of goals allow you to shift your focus from the ups and downs of your results or your daily P&L to the processes that produce it. To be clear, you're not eliminating result goals. I don't want you to stop focusing on results. I want you to drive towards them in a more disciplined way. Making money remains the dominant focus long-term, but how you make money is your dominant focus short-term. The way to do that is to elevate the importance of process goals. You already show up every day with the goal of making money, but none of you would ever choose to do it by relying on getting lucky after having made a series of bad decisions. Whether you realize it or not, you place a high value on the quality of your process. Elevate your process goals, and your focus won't be dominated by results. Think of this as goal diversification. This is particularly important in trading since you can control whether you achieve your process goals in the short term. These process goals can become even more specific and detailed as you determine how to achieve each one. Take the goal of improving discipline. Define how you'll do it. For example, by working to create a clear map of your discipline A to C games, improving recognition of early signs that discipline is falling, and actively working to correct it in real time. Then, even when you're tired or in a drawdown, two things that normally make it harder to maintain discipline, you can see progress that a sole focus on results would have missed. Ultimately, the energy you put into achieving your process goals is fueled by your strong desire to reach your result goals. And the stronger your desire to achieve your result goals, the harder you'll work on your process goals. Process-based goals are especially important in industries like trading, where the variance makes it difficult to have full control over your monetary results. If at the end of the day, you don't hit your monetary goal, but you're now able to focus for 5 hours without getting distracted, execute your strategy, and consistently follow your routine, at least you'll know you've improved and controlled what you could. Distractibility. There's a shocking level of distractibility in today's world, and traders are not immune. In fact, in some ways, you're particularly exposed to it. You must sift through streams of data from multiple sources in order to interpret and capitalize on opportunities. But as you interface with these data streams, it's easy to allow information that's irrelevant to your trading decisions to flow in. You've got the charts open, but you're trying to do something else on the side. and you end up making a subpar trade because you weren't focused enough to make a proper judgment. You may think such distractions don't affect you, but here's a quick way to demonstrate what happens when the mind attempts to do two things simultaneously. While reading the next several lines, focus on the sensation of your legs against your chair or the feeling of your feet on the ground. Force yourself to feel the sensation of your legs or feet while paying close attention to what you're reading. See if you can notice the shift that your mind makes between reading and sensing your legs or feet. Do you notice how each time your attention switches, you lose information from the other point of focus? Your eyes may continue to scan the page, but you no longer pick up every word, and you may even have to reread them. And every time you only focus on reading, you lose awareness of the sensation in your legs and feet. Imagine this happening while trading. Every time you focus on Twitter, a text message, or an unrelated discussion, you may fail to pick up data relevant to your trading decisions. Focus can be broken down into two parts: attention and concentration. While people often use these terms synonymously in terms of focus, there's an important distinction. Attention is the direction of your focus, determined by your goals, needs, motives, interests, priorities, and values. Concentration is the amount of focus you have, which is ultimately determined by your level of energy. If these subtle differences are unclear, think about the way in which people talk about focus. When someone says, "pay attention," they're telling you where to focus. When they say "concentrate," they want you to increase your level of focus. This distinction is important because it illustrates the two ways of improving focus: give it better direction and increase the amount of it. Attention. Imagine that you're in a dark room. Hidden in the darkness are all the areas in your life fighting for your attention: trading, family, Twitter, cat videos, clickbait, exercising, a good meal, your next trip, picking up the dry cleaning, etc. Literally everything that you could be interested in is represented on the floor, ceiling, and walls. You can't see them right now because the room is dark, but they're there. Now imagine you turn on a flashlight, much like how you first open your eyes and start your day. You shine the light around to get your bearings and understand all of your options. Then it's time to choose. You decide to trade. You shine the flashlight in that direction, and all of the things that are integral to your success are illuminated. Your routine, your pre-market checklist, and trade journal are all there. Immediately, you know exactly where to focus because it's lit up by the flashlight. And just as importantly, everything unrelated remains hidden, in the dark. There's no other options illuminated by the beam of light. Trading becomes your entire world because every other option is invisible. That's the power of your goals: to point your focus in the right direction and block out all the other things that don't matter. Guided by your goals or motives, focus is your tool for gathering the information needed to make decisions. Yet what does your focus actually look like during the trading day? Does it stay in the right place for an hour or so and then fade like the batteries are dying? Is it a wide beam that casts light across many things at once? Or is it a narrow beam that jumps around? If your goals aren't up to date, if they lack deep personal meaning, if they're too far away to feel real, or they lack clear details, your focus will never reach the level that's truly possible. Moreover, every strategy that you use to fix your focus will only be a band-aid. You want your focus to be completely consumed by what you want to focus on. The question is, why does it get pointed at something less relevant, or even irrelevant, when you're trading? Saying you're distracted is too simple. When you look closely at the motives or reasons behind why you choose to have your attention drift elsewhere, you'll find a conflict. Consciously, you might know that trading should consume all of your attention, but your strength to hold your focus in the right place has been compromised by the desire to shine the flashlight onto something else. For example, let's say that you find yourself unable to stop paying attention to the trade ideas from other traders on Twitter or those of a trading group. Why is that? Perhaps you want to be entertained or social. In order to get yourself to consistently focus on your charts and be disciplined in your focus, you need to resolve the reason you seek diversion during the trading day. Use the mental hand history to get at the root of the conflict. This perspective was particularly helpful for Brian from Canada. Remember him from Chapter 3? His inchworm was too wide, and the idea of sucking less, along with a framework to achieve his lofty goals, helped him to swiftly identify and correct greed and fear. Yet while those problems had been addressed, his focus still needed work. For a long time, the way he had dealt with the emotion was to procrastinate, lose focus, and think about his future. His mind would frequently wander to sports, finances, or imagining an ideal life. With the greed and fear removed, we took aim on improving his focus by applying a strategy of taking defined 5-minute breaks throughout the day whenever he felt very distracted. When this had happened previously, he would disappear for a lot longer than 5 minutes, often the rest of the day. He didn't understand how to reliably get back in front of the charts. At first, he set the 5-minute break to occur every 25 minutes, following the Pomodoro technique of time management. During the break, he would first note what was on his mind, then give himself a few minutes to relax before re-emphasizing process, focus, and execution for the next 25-minute block. This really helped him to reset and refocus. Throughout the day, I also had him log every distraction to make him account for every instance his focus wasn't optimal. These distractions range from something as simple as thoughts about sports to as large as getting lost in social media or imagining his future. Lastly, we found that his focus issues were connected to his experience in school and in his prior corporate job. An intelligent hard worker, he naturally thrived in both environments and was very successful. He expected to have the same results in trading, despite the environment being very different. The uncertainty and lack of structure exposed weaknesses in his focus that had begun in school, because he hadn't needed to fully focus to get straight A's. His mental hand history revealed the underlying issues. 1. What's the problem? I have very high expectations about the amount of money that I want to make and what I want to achieve. And I frequently envision a future income level and lifestyle, which includes traveling the world and living in the Caribbean. 2. Why does the problem exist? Trading is my source of income to fund that lifestyle, but it's hard and can be a real struggle. These thoughts are an easy escape from the struggle and the work I must put in today in order to eventually get there. Effectively, I'm choosing comfort and ease in the short term. 3. What is flawed? Thinking that I can achieve the outcome that I want without actually putting in the work. I know what I had to do in school and in my previous corporate jobs, and I'm expecting my intellect to get me what I want without having to work for it. My past experience gave me a false sense of certainty that I can expect to be as successful in trading as I was previously. 4. What's the correction? I need to grow beyond my expectations from the past. I don't have guarantees here. I have a lot of belief and a lot of desire. I've gotten this far by half-assing it. Just think of what I could do if I put my full effort into doing the work needed right now. I must embrace the discomfort and put in the focus needed to pursue my goals. 5. What logic confirms that correction? I've faced uncertainty successfully before. I just didn't appreciate it. I need to take trading head on, with a process that allows me to get where I want to be. If I feel comfortable, I'm doing it wrong. Take the risk. It's okay to fail. It's okay to have trades lose. If I escape, I stop myself from learning and take away the chance to attain my dreams. Taken together, he worked the process day after day, and over time he naturally progressed beyond the 25-minute blocks. Now he focuses until he hits a point where his distractions become disruptive. Sometimes his focus can last as long as several hours or as little as 20 minutes, at which point he follows the 5-minute break routine to reset and start again. Concentration. With your goals set, attention directed where it needs to be, and any conflicts removed, the next part of the equation is concentration. Increasing concentration is no different than the overall idea of increasing discipline. There's an endurance component to it that requires energy. Many of you start with sufficient energy, but quickly lose it because you lack a strong connection to your goals. Ideally, you want your goals to be so well known, they're like the back of your hand. On the other hand, some of you lack endurance. You're like an out-of-shape athlete. To build your endurance, you must design an exercise program to increase the duration of high-quality focus. Much as there's tremendous diversity in how athletes train, there's considerable diversity in how traders operate. So much so that it's tough to create a defined workout for everyone. Ultimately, you must do what works best for you. That said, the general advice that has worked well for my clients to strive for is around an increase of concentrated time by 10% week over week, combined with a week of no increase every 4 to 6 weeks. That may sound low, but the key is finding a way to achieve sustainable growth, not temporary progress fueled by inspiration. Having mapped your discipline problems earlier in the chapter, you can now go deeper into detail on the specific ways your focus becomes divided. Follow these steps. 1. List all of the things you focus on that are low value or that you'd consider a distraction. For example, trading group banter, daily P&L, positions, or divergent moves in related markets. 2. Determine when they tend to arise. For example, are they more present at the beginning, middle, or end of a session? 3. Rank the severity of the distraction as minor, moderate, or severe. 4. Select one or two from the most severe category. 5. When the urge to engage in those distractions appear, push yourself to focus on an amount of time that's doable, but not overwhelming, 5, 10, or 20 minutes. Too often, traders try to fix all their distractions at once and think that it's easy to improve just by keeping it in mind. The urge to engage in those distractions is strong, and the more you avoid it, the stronger the urge gets. That's expected in the short term. You're battling to build discipline around your focus. That takes repetition and experience. Work hard to maintain focus for 5, 10, or 20 minutes, and then either do it again or take a short break before doing it again. Trying to focus for 3, 4, or 5+ hours at a time can feel overwhelming, but chopping up the time makes it easier and feels more like a workout. Another thing you can try is something I call prepare for perfect. This is an experiment that can be good for those of you who are easily distracted or if emotional problems previously affected your focus. It can also be useful if you haven't been in the zone for a while and have forgotten what it's like to even be there. Your goal with this experiment is to create the best possible conditions to reach a peak level of focus for trading. Imagine your next trading session was the most important of your entire life. What steps would you take to ensure your focus was perfect? This is just an experiment, so really go for it, and don't worry about whether it's practical to do on a regular basis. Identify everything you need in order to be at your best: getting proper sleep, planning and eating an optimal diet, getting a moderately intense workout, avoiding social media for 24 hours, etc. Then actually do whatever you think it'll take, even if it means setting aside a few days to properly prepare for the session. The purpose of this experiment is to experience optimal focus. From there, you'll gain insight into what it takes to be at your peak, and perhaps more importantly, recognize more easily when your focus is poor and why, which will feed your ability to push yourself to increase the duration of your focus for 5, 10, or 20 minutes at a time. Lastly, everything I've talked about in this section was framed around improving intraday focus, but all the concepts and strategies also apply to work outside of trading hours. Laziness. Calling yourself lazy is actually lazy. Rather than analyzing why you lack the motivation to do what you ought to be doing, you conclude that you're just lazy and treat it as an incurable disease or an immovable part of your character. Laziness seeks this kind of comfort. Believing laziness is something you can't change is easy. Laziness loves doing the minimum. If you believe deep down that laziness is permanent, even if it's just a small part of your character, it would be illogical for you to try to do anything to change it. However, laziness is not a fixed trait. Breaking out of this ailment takes some work. This section can make that task easier. You might equate laziness with having zero motivation, but it's actually impossible to have no motivation. Instead, think of being lazy as having strong motivation to sleep for hours, watch TV, or mindlessly surf the internet. While that might seem like I'm just changing around words, stating it that way is important for understanding and fixing the problem. Laziness is actually a skill that, for better or worse, has been learned. You've learned the skill of doing something other than what you ought to be doing. Instead of learning how to be productive, you've learned how to be lazy, and you're quite good at it. In trading, laziness is more likely to show up for the tasks around trading, like reviewing previous trades, developing new trade ideas, and reading research, versus the desire to get into the action and trade. The intensity of trading gives you the rush that makes it fun and exciting. Research, on the other hand, can be tedious and boring. You have to generate the intensity to make it valuable. Why do the research or analyze your trades when it's easier to do something mindless? Laziness can develop for many reasons. Perhaps it started early in your life if you weren't pushed to excel, or if the environment wasn't that challenging for you. I'm not saying that all people who are lazy are smart, but I've seen many people who are very smart develop poor work habits when their educational environment didn't challenge them. They did enough to meet their goals, either get A's quite easily or get by without trying very hard and still get into a good college. In comparison to the standard provided to them, they weren't lazy. However, relative to their potential, they were incredibly lazy. But their potential wasn't the benchmark, externally or internally. The habits that formed during that time continue today. People also become lazy when the structure they're used to having in their lives is gone. When living with family, going to school, or working for someone else, you don't have to think much about what to do, you just have to do it. The value of having that structure provided for you often goes unrecognized until it's gone. Now you have to do both. Decide what to do and do it. That extra layer may not seem like much, but it makes life or trading more challenging and can lead to laziness. Or maybe after you started making good money and had some success, you no longer felt any urgency. Perhaps you were incredibly motivated for much of your life and trading career. But having reached the goals you dreamed of, whether being able to quit your job to trade full-time or feeling financially secure enough not to worry about money for years, laziness has unexpectedly popped up. The issue here is that you're now either coasting on your previous success, expecting it to easily continue, or you've simply failed to set a new goal or determine new things that challenge you. In this way, laziness is just a signal of a lack of direction that drives you. Finally, trading is an enterprise that attracts people with the fantasy of easy money. They lack the right work ethic prior to trading, and as a trader, struggle to put in real work. Trading is enjoyable and doesn't have to feel like work, but it's easy to lose sight of how to become successful. Choosing productive activities and having a more rigorous work ethic may not seem like fun at first, but it's definitely more fun than failing, having an ordinary job, or proving your doubters right. Success is also gratifying and makes the mundane tasks that are necessary to achieve it less painful. This doesn't mean that putting in the extra hours of work is more fun than going out with friends or taking time off to travel. But those decisions take on a different context when they give you a greater chance of reaching your goals. To begin correcting this problem, you need to change the way you view yourself. You're not lazy. You're highly motivated to do other things rather than what you ought to do. Motivation is simply the energy you have behind your goals. And when you look more closely at the specific habits you avoid and the ones you choose to do instead, you gain insight into the reasons behind your preference for unproductive activities. You may be changing the flawed idea that laziness is a character trait, breaking out of the mold where your potential is defined by other people, learning to hold yourself accountable to your own structure, or breaking the illusion that money in trading comes easily. Find the motivation to drive towards your own vision. Redefine your goals as a trader or for your career. Then zero in on the day-to-day micro decisions. There's a list of things you should be doing, and there's a list of things you're doing instead. To consistently choose more of the things you ought to be doing, uncover the reasons behind your laziness, and build the skill to make better choices. 1. Write the excuses you make for choosing the lazy things you do. 2. Write why each of those excuses is flawed or wrong. 3. List all the productive things you can do instead, and the value of each activity. Then when those moments arise, think of the short and long-term value of doing the productive habits compared with the low-value, immediate gratification lazy ones. Doing what's less fun now means you can have much more fun in the future. Work harder when it's hard, and eventually it'll become easy. Don't hide behind your potential. See how good you can actually become. Laziness seeks comfort, but you can no longer delude yourself into thinking that laziness is something that you can't change. You can no longer lazily call yourself lazy. Maybe that will compel you to dive into the reasons you form these habits, patterns, or skills, and develop new ones. Procrastination. Constantly putting off what's important defines the skill of procrastination. Sure, there's a lot you could be doing, such as reviewing your trade journal, researching a new strategy, or upgrading your chart reading skills. But it's easier to delay that work until tomorrow. The problem is that tomorrow, for those of you who are highly skilled procrastinators, is a fantasy that will never be realized. You're a master at delaying today's work, but when tomorrow becomes today, you're not skilled at getting work done. You're skilled, once again, at delaying it until tomorrow. The fantasy is that you'll actually do the work tomorrow, but what I just described is why that won't happen, so the pattern continues. Eventually, you become fed up with your antics, realize that you need to make some money, worry you might get fired, or there's some other reason that makes you feel like your back is against the wall. Being in that position triggers a rush of inspiration. You put your nose to the grindstone and rip through all the things that you've been delaying and avoiding. Unfortunately, when you successfully avoid the worst case, you're more likely to slip back into that habit again. There's no real consequence other than some wasted time and opportunity, and that's a business expense you're willing to take. Your behavior has seemingly been rewarded, and there's no reason for you to change. And yet here you are. which means that you know procrastination is causing some kind of damage and it's time for a change. If you want to stop procrastinating, you first must eliminate the belief that there's always tomorrow and develop the skill of doing the work that you ordinarily delay. That means learning how to work when you're not under intense pressure or stress. Working with your back against the wall is easy. You have no choice but to get it done. Procrastination took away your options, but it also created a lot of stress and pressure in order to focus and motivate you. To break that cycle, you need the strength and willpower to remove delaying as an option. Remember, today is when improvement happens, not just in your trading, but also in reducing procrastination. Today is your only opportunity to improve. Tomorrow is a fantasy. One of the problems with procrastination is that the value of the work you end up doing under intense pressure gives you a false sense of strength and mastery. Obviously, this is different if you're studying for an exam related to work. But if we're talking about upgrading your competency that defines you as a trader, in these periods of intense work, you're mostly expanding capacity at the front end of your inchworm. You're not permanently upgrading your C game. Instead, you end up with a wide range and all the problems associated with it. Correcting procrastination helps you narrow your range and build your competence in a more stable and consistent way. Building the skill to work consistently doesn't happen overnight. As I've discussed before, start with what you can guarantee you can do regularly, even if that means just working on it for 5 to 10 minutes a day. Of course you can do more, but you can't sustain that output consistently yet. As 5 to 10 minutes becomes easier, you can scale up the time and eventually build towards what's optimal. In the end, you'll find this to be a much more sustainable way of developing competence than delaying and cramming. In this chapter, we've looked at how to tell when you're dealing with an emotional versus actual discipline problem, and the many signs of discipline problems, and the ways that issues with discipline might manifest. You've also learned multiple tactics for addressing challenges with discipline, from focus tracking and time management tips to using the mental hand history. You should be well on your way to enhancing your discipline, or at least knowing what steps you need to take to improve it. Early in the book, I talked about how control isn't a solution, resolution is. Resolution frees you from having to constantly fight greed, fear, tilt, overconfidence, lack of confidence, and poor discipline. Instead, when you permanently correct the performance flaws that cause those problems, your mind is freed up to focus on trading and figuring out how to make more money. We've been steadily working towards resolution throughout the book. Now that we've explored the many ways that emotions and discipline problems can hijack performance, how to recognize them, and identify the root cause, you're ready to take the final step. I'll get deeper into how the brain works so you can correct your problems in real time while avoiding the brain's tendency to commandeer your good intentions. Chapter 9. Correct your problem. Give a man a fish, and you feed him for a day. Teach a man to fish, and you feed him for a lifetime. Origin unknown. You realize by now just how detrimental your mental game problems are. Envision them gone. That's what resolution can do, and it's an outcome worth the hard work it takes to get there. I imagine some of you are overwhelmed by what you've read thus far, and others are optimistic about what this system can do. Rest assured that at this point you have the foundation for how to recognize your problems and correct your reactions. Now you should be firmly focused on the work needed to resolve them. Resolution is your ultimate goal because that's how you can truly take your performance to another level. For many of you, the road to resolution isn't a straight line and looks different than you expected. Having been a coach for over 15 years, I've learned a lot about the process involved with resolving problems. I've crafted this chapter to make that process easier and faster, regardless of your starting point. Traders often assume that their mistakes, especially mental and emotional ones, should be easy to fix. You know what the mistake is, so just don't do it anymore, right? Seems like a simple enough strategy. But in the heat of the moment, it's not that simple. Mistakes continue to happen, and you either get pissed off, feel pressure, lose confidence, lose motivation, become distracted as a form of denial, blame something random, make excuses, or any combination of the above. You know the definition of insanity is doing the same thing over and over, expecting a different result, yet you tenaciously believe the problem should be fixed easily, and still don't work on it. Plus, since you're now even more aware of it, you think, there's no way I'll make that mistake again. And when it doesn't show up for a few days, a week, or even a month, it gives you a false sense of confidence. But eventually the mistake happens again, and your emotional reaction is even stronger this time. This chapter is your way out of that cycle of chaos. You'll dive a bit more into how your brain works and how it can trip you up so that you can avoid the problems it might be causing. You'll learn how to correct your problems in real time, as well as how to build your strategies into a daily habit, since repetition is the biggest factor in reaching resolution. Finally, you'll understand how to evaluate your progress and avoid common reasons progress can get derailed. Let's start by looking at a few key ways your mind might be hijacking your good intentions. Malfunctioning mind. We could spend years talking about the intricacies of the human brain. Untold number of books and papers have been written to decipher how it works, and that research will continue. But all you really need to know are a few key principles. The brain is organized in a hierarchy. The first level is where all the most important functions of the brain are stored, such as heart rate, breathing, balance, and sleep and wake cycles. Skills you have mastered, like riding a bike or inputting an order, are also there. The second level of the brain is the emotional system, and the third is the mental level, containing all of the higher brain functions such as thinking, planning, self-awareness, organization, and emotional control. But the hierarchy has a catch, and it's a big one. When the emotional system becomes overactive, it shuts down higher brain functions. This is why you make poor decisions when your emotions run too high. The brain prevents you from being able to process information correctly. When emotions are overactive, the loss of higher brain functions is something that no one can control. Both positive and negative emotions can cause this breakdown in mental functioning. For example, you learned in Chapter 7 that while having confidence is important to performance, too much of it can be a problem. When you're overconfident, the excessive amount of emotion flooding your mind compromises your decision-making. This could lead you to overlook some factors or overestimate the accuracy of your opinion, and that alters your evaluation of risk. Regardless of the emotion, the following can also happen. When emotions are at their highest level, shock, euphoria, blind rage, your mind goes completely blank and you stop thinking altogether. Your mind moves so fast that you miss key pieces of data, so your decision-making process is incomplete. You overweight the importance of some factors and fail to consider relevant ones. You know the right answer, but can't access it, as if your head is in a fog. You fall back into bad habits that you're surprised to find out you're still doing. You're aware that what you're doing is wrong, but you can't stop yourself. It's like you're compelled to trade bigger and take excessive risks. Your focus narrows, and you tunnel into one of your indicators and ignore others that you typically use. You've identified a juicy trade, but can't execute it. Take a minute to let the way that overactive emotion shut down your higher brain functions sink in. If your strategy doesn't take this into account, you have very little chance, aside from pure luck, of fixing anything. There's even a scientific principle that describes the relationship between emotion and performance. The Yerkes-Dodson law states that your performance improves as your emotions rise, but only to a certain point. As this law defines it, your threshold is the tipping point on the right side of the curve, where emotions start to become overpowering. At this point, performance declines because the emotional system begins to shut down higher brain functions, like thinking, decision-making, and emotional control. When that happens, you lose access to the knowledge and skills you're currently learning in proportion to the intensity of the emotion. The further you pass your emotional threshold, the more knowledge you lose. Things that are brand new are the first to go. Skills that are much better known and close to being mastered are the last to disappear. You know your emotion has crossed your threshold and become overactive when it's begun to impair your thoughts, actions, perspective, and decision-making process. Of course, everyone's threshold is different. It's a very personal metric. Keep an eye out for when your biases start to pop up more, your decision-making ability starts to change, and your access to certain information starts to shrink. On the left side of the curve, the opposite happens. When you don't have enough energy or emotion to think, as occurs when you're tired, bored, burned out, or lacking discipline, you need to build up enough emotion to kick the thinking part of the brain into gear. Emotion is essential for performance. Problems only start when there's too much or too little. The mental game strategy outlined in this chapter is designed to keep your emotional level at the top of the curve, so your performance can be at its highest level more often. On the surface, this concept may seem simple, but it has massive implications for how you address emotional problems. While you can't control the fact that the emotional system has the power to shut down your ability to think, you're not powerless. You just have to work within this limitation. You must start trying to control your emotions before they have gone too far past your emotional threshold. Timing matters a lot. If you don't catch the rise of emotion early and it becomes too intense, you'll be in for an uphill battle for control. The prefrontal cortex is the area of the brain responsible for emotional control, which is one of the higher brain functions weakened as emotions rise. At the exact moment when you most need this part of your brain, it can't respond as well because of that emotional intensity. Simply put, emotion has the power to weaken your ability to control it. And the further your emotions rise past your threshold, the lower the odds that you'll be able to regain control. Too often, traders begin trying to control their emotions after their ability to think has weakened. That's like bringing a water pistol to a gunfight. Whether the loss of higher brain functions is caused by overconfidence, anger, or fear, the consequences are significant for traders. You rely on higher brain functions to make money. This is some of the most valuable territory in the brain. This is where you think and weigh information from multiple sources, such as prior knowledge, experience, actions, and of course, real-time market data. Understanding how your brain can malfunction gives you another tool that takes you closer to achieving resolution. Now let's get into a real-time strategy that brings the battle for progress to the front lines. Real-time strategy. So how do you resolve a mental game problem? You must get to the point where you can correct your reaction as it happens. Once you've learned to recognize when your performance flaws have been triggered, that's your cue to fight back with a correction that in real time quickly gives you greater mental and emotional control. What makes this system powerful is that when you use the correction in real time, you also gain repetitions needed to eventually reach resolution. 2 benefits from one action. Correcting your reaction is a combination of having the right logic and ensuring that logic is so clearly defined in your mind that it's strong enough to stop the pattern in its tracks. From your work in chapters 4 through 8, mapping your pattern and using the mental hand history, you've identified the correction. Now it's time to use it. To do that, you use a 4-step process that I'll explain below. The amount of detail needed for the explanation might seem overwhelming, but once you get the hang of it, you'll find that you can complete this process in a matter of seconds. Learning to correct your reaction is where a lot of the hard work in this system lies. First you find the flaw, then you come up with a correction. But to truly change flaws, biases, wishes, and illusions, you must repeat the correction over and over and over again. You become like professional athletes who spend dedicated and focused time to hone their technique so it's strong enough to compete. Here you're learning a technique for the mind. In this way, you're mastering the correction so that it upgrades and permanently corrects the flaw. Once permanently corrected, you've reached resolution. The old way of reacting is disabled, and you automatically have the presence of mind needed to trade at your highest level. I liken this process to chopping down a tree. You may want a chainsaw, but you get an axe. For some of you, the tree is large, you're weak, and the axe has a blunt edge. Over time, as you work the process, you get stronger and learn how to sharpen your axe. Just like becoming a skilled trader, you have to put in a lot of work. There's no other way. Step 1. Recognizing a problem has been triggered. This is where mapping your pattern really helps. As I said at the outset of Chapter 2, you can't stop or correct a problem that you can't see. Now's the chance to use the map of your pattern to identify the signals a problem has been triggered. Eventually, you want to get to the point where your map is internalized, so you can easily recall it under intense emotional situations. Until that point, keep it nearby so you can quickly reference it. Once you recognize a signal, that's your cue to move on to Step 2. Step 2. Disrupting momentum. Newton's first law of motion tells us that an object in motion stays in motion until acted upon by an outside force. Your pattern is like an object in motion. There's an unmistakable momentum to your emotional reactions as they barrel towards the same terrible conclusion, unless you become the force to challenge it. The best way to do that is to disrupt the momentum of the pattern as soon as you recognize it. The primary purpose of disruption is to create separation between the reaction and the correction, which increases the odds of the correction having an impact. As soon as you recognize your pattern has been triggered, use one of the following 4 methods of disruption. Take a deep breath. This is not some esoteric kumbaya kind of thing. A singular deep breath can produce a distinct effect while being simple enough that you don't have to step away from your desk. Take a deep breath that fills your stomach, not your chest. This is called diaphragmatic breathing, and it cues your body to relax. Google it. Also, focus intently on your breath. The strength of your focus is a large part of where the disruptive power comes from. If this is new to you, take some time to train yourself in the process. Several times a day or once an hour, imagine that some emotion you're struggling with was triggered. Practice taking one diaphragmatic breath while strengthening your focus on your breath. Over time, you'll notice a distinct improvement in the strength that breath has to stop the problem in its tracks. Write. Take a few moments to write down your thoughts, emotions, or whatever is on your mind in that moment. You can type or handwrite your notes. It's a personal preference, so do whatever works for you. Stand up or take a walk. In heated moments, traders often naturally stand up from their desk or take a short walk to make sense of what's happening. You may also try combining this by going for a walk and then writing down your thoughts when you get back. Talk. Some traders prefer to vent to a colleague in their office, in an online forum, or to other trading friends. You already do these things instinctively. The idea is to turn them into deliberate techniques and strengthen their effectiveness. If you find there's one you already do, it makes sense to start there. You can also use a combination when the reaction is more severe. For example, a deep breath only works when the emotional intensity is low, so write and then stand up to disrupt the pattern when the intensity is higher. Traders who only make a few trades per week have the luxury of having time to disrupt their pattern. The risk of missing out on a profitable trade is low. However, it's clearly suboptimal to have extended or recurring periods where you're more focused on managing your emotions in this way. Over time, the goal is to shrink the amount of time you're away from your desk. On the other hand, traders who make several trades per hour must develop a quick process to disrupt their pattern. Their goal is speed, and that often requires spending extra time to train the process to the point where you can easily apply one of the 4 options above. Step 3. Injecting logic. Injecting logic is the real-time antidote for the emotions causing errors in your execution. Leveraged in the right way, it's one of the strongest tools you have to reach resolution. Injecting logic builds on what people tend to naturally do when facing a mental game problem: talk themselves through it, and turns it into a technique that can be trained. Thinking is your primary tool to fight against your pattern, and the benefit of what psychologists call self-talk has been well established in performance research. The key is to apply it when emotions are still small and to use logic that you have trained. The goal is to craft a bite-sized statement or phrase that you have written out, rehearsed, and reviewed prior to each trading session. This makes it strong enough in your mind to have an immediate impact on your emotional state, prevent secondary emotion, and work towards a lasting correction to your underlying flaw. Here are a few examples. FOMO. The market is a constant stream of opportunities. I will not capture all of them. Fear of failure. Sometimes the risk from staying on the sidelines is the greater risk. Hating to lose. I'll win some and I'll lose some. Losses are inevitable. But as long as I control my emotions when losses occur and continue trading within my strategy, I will profit over the long term. Mistake tilt. Hating mistakes is like hating to learn. If I actually learn from it, the money lost is an investment in developing a bigger edge. Injustice tilt. I get good luck too. Look for it and stick to my strategy. That's how I make money long term. Lacking confidence. I spent 1,000 hours on this plan. Am I really going to let one trade change it? Overconfidence. My head is in the clouds. Fantasizing about what I want to make from the trade doesn't mean that's what I'm going to make. Do your job. Boredom. If I go looking for action for the sake of action, that makes me a gambler, not a trader. Focus. Trading is a job. Run it like a serious business that demands my best. When the session is over, I can focus on other things. Not now. For your logic statement to be effective, it must be potent. It must represent what you have uncovered in the mental hand history and accurately address both the underlying flaw and your understanding of why it's flawed. When you have the right logic, it has a noticeable effect in reducing your emotions in the moment. Early in the process, the decrease in emotion will be small but distinct. Eventually, you'll reach a point where the logic is so potent that you immediately feel a significant change. To figure out the correct logic to inject, Take what you wrote in steps 2 through 5 of the mental hand history to craft your statement or phrase. At the start, it's okay for it to be based on negative language such as, "You can't be perfect," and "expecting to be is a recipe for pain." Positive language can sometimes lack potency. Don't get hung up on the idea that negative thinking is bad. Also, don't get hung up on trying to craft the perfect statement right away. Just try something out and give it a few days to see if it has any impact on your emotional state. The standard of improvement is to suck less. Remember, you don't get a chainsaw. Start wielding that axe and get some feedback. Early in the process, to some degree, it doesn't matter what you say, which means you're at risk for a placebo effect. Sometimes just saying something reasonable can stop your pattern. This is fine at the start, but remember that managing a problem isn't the same as resolving it. Take, for instance, not closing out a losing position because you hope it will come back. You know it's wrong to hope a position will come back, so you say, "Hope isn't a strategy, close it and move on to the next one." While that's reasonable and gets you to close out the position, you're not addressing why you were so reluctant to close it. The same could be said for any of the logic examples above. If your emotions continue to reoccur and cause the same problems without any signs of progress, you haven't gone deep enough. Injecting logic becomes no different than any of the other strategies designed to temporarily control emotions, such as denial, avoidance, distraction, or desensitization. Don't make this mistake. Dig deeper into your problem. Reevaluate what you wrote in the mental hand history, and devise a new injecting logic statement. If you have the right logic and use it at the right time, it will have an effect. Leverage this tool. And remember, one of the major benefits of injecting logic is that it simultaneously has an effect on the current emotion, as well as moves you closer to resolution by upgrading the faulty logic, biases, and illusions. But the latter takes time. You must repeat the process again and again and again, like the tree you're chopping down. Regardless of what logic you settle on, train it. This is how you create logic that's strong enough to cut through and decrease fear, greed, or a loss of confidence in real time. Spend time outside of trading hours to review your mental hand history and your logic statement. Commit them to memory. Test yourself. When you practice your deep breathing, pair it with your logic statement so the two steps become tightly linked. Memorize not just the actual words of your logic statement, but the intent. You should be so fluent in this logic that you can recite it in any situation under intense stress. The stronger the logic becomes in your mind, the more potent the injection. Sometimes the correct logic is simply an idea you already know well, but haven't trained or applied in the right way. When emotions have caused your mind to malfunction, those ideas are gone. They're either too weak to be remembered or don't have the desired impact on your emotional state. Here are some ideas for how best to use your injecting logic statement. 1. Use your own language. The statement or phrase needs to reflect the way you actually talk and think. Make sure you use logic that truly fits. The perfect statement is the one that does the job for you, not the one that sounds best or works for others. 2. Take an expanded view. Some clients like to write an entire paragraph that expands on the themes and ideas surrounding the correction and flaw. Then at the start of each trading day, they review the paragraph and pull out a line, phrase, or word to inject that day. For them, potency comes from having an expanded or deeper view of the problem and correction. 3. Write down your phrase or statement. Put it on a note card, sticky note, Word document, cell phone, or whatever you find most convenient. This way you don't have to dig it out of your memory at a time when your mind is malfunctioning. 4. Adjust if you need an auditory or multimedia approach. Consider making a voice recording of your statement, or pair it with a picture, song, or movie clip. 5. Review the logic hourly. If you have difficulty avoiding severe mistakes, consider preemptively reviewing your logic every hour, half hour, or on a schedule with some regular frequency. This way you'll be more likely to catch the emotion, prevent significant buildup, gain control more quickly, and minimize the damage. 6. Avoid these common mistakes. If injecting logic doesn't work, usually it's because you began using it after your emotions were already too strong and had crossed your emotional threshold. At this point, it's too hard to think clearly. Injecting logic is really just thinking. Therefore, if your emotions have weakened your ability to think, trying to inject logic is like attempting to run on a sprained or broken ankle. You must start injecting logic when your emotions are small. That may require you to revisit your pattern and look for earlier signals to map. Your statement wasn't tailored enough to the performance flaw. Go back to the mental hand history and work through steps 2 and 3 again. There's more you need to understand about the underlying cause in order to create a potent statement. Accumulated emotion instantly flooded your mind and you didn't even have a chance to use it. Something new threw you off. Either your existing problem changed and you didn't recognize it was triggered, or you're dealing with a new problem entirely. You need to study it more. The logic is not strong enough yet. Finally, make sure to hone your ability to know when to use injecting logic. Become skilled at identifying the key moments when you need to disrupt the pattern so that instead of acting on emotion, you're actively fighting to correct it. Inject logic when emotions have been triggered, and you have to fight to maintain the right perspective. For example, when you're taking heavy or consecutive losses, missing opportunities, or likely to move your profit target. All the work you're doing to make the logic strong is for these moments, so you can increase the odds that you can correct your reaction and prevent mistakes. Early on, you're going to fail when tilt, fear, or greed shut down higher brain functions. The key is working to lengthen the time it takes to fail and to minimize the execution errors when you do. As you gain more experience and repetition, the stronger your logic becomes, and it remains in use at times it previously would have failed. Momentum is in your favor. Whereas previously emotions got the better of you because you didn't know enough to avoid them, now that only happens when trying to apply the correction in new or challenging situations. Step 4. Use a strategic reminder. Up to this point, the strategy is focused on correcting your emotional reaction so that you're less likely to make a mistake. But greater emotional stability doesn't guarantee that. As soon as the malfunctioning mind is in play, strategic and technical aspects of your trading also disappear from your mind, potentially leading you to trade outside of your plan or strategy. A strategic reminder can protect your decision-making process and increase the odds of improved execution. Giving yourself a simple reminder can go a long way towards improving real-time execution as well as training the weaker aspects of your decision-making process. When mapping your pattern, you already identified the ways that your decision-making process gets altered. Flag the type of errors you typically make, the factors that you ignore, and the changes to your perspective on the market or price. Now use this information to protect yourself at a time when the risk of making a mistake is high. To create your strategic reminder, think about what happens when emotions are present and select one of the following options. Write it down and keep it with your injecting logic statement. You have several options. Option 1. Write down your most common mistakes. Keeping a list of these mistakes handy reminds you of what to avoid. This goes back to the power that recognition can have in the short term to create some immediate improvement. For some traders, the corrections to these mistakes are obvious, but they don't realize it until after they make them. Option 2. Write down your entire decision-making process. While some traders see this as tedious, others like having all of this detail. They embrace the opportunity to articulate their entire decision-making process and ensure they're training like an athlete and perfecting their technique. Option 3. Write down only the technical factors or data you fail to consider. If you think option 2 is too tedious, here's the shortcut. Rather than reminding yourself of your entire decision-making process, focus only on what goes missing and force yourself to consider it. The aim is to establish higher levels of execution and decision-making. That requires a 1-2 combo of injecting logic for the mental and emotional side and using a strategic reminder for the technical and strategic side. Adding a strategic reminder is different than the emotional and mental work that is the main focus of this book, but it directly fits into the system because it's a critical piece that can minimize mistakes. Some of you, like the scalpers out there, don't have time to use a strategic reminder. That doesn't mean you can't benefit from the exercise of nailing one down, even if you can't use it in real time. Instead, it can be a helpful tool that you have as part of your pre-market routine, reinforcing the key elements of quality execution that you're trying to make when your emotions pop up. To recap, the complete real-time strategy is 1. Recognize that your pattern has been triggered. 2. Disrupt the momentum of that pattern. 3. Use injecting logic to correct the flaw. 4. Use a strategic reminder to improve your execution. Again, with practice, these 4 steps can be completed in seconds. As you get better and better at recognizing and disrupting your pattern and injecting these corrections, your ability to recover will change from hours or days to seconds and minutes. Like any other skill, it may feel clunky at the beginning, but you will eventually get smoother and faster. Rinse and repeat. Until the problem is resolved, it's going to keep coming back like a fly that won't leave you alone. Be prepared to go through the 4 steps again and again. On some days, you'll need to repeat these steps more than on other days. No 2 days in trading are exactly the same. As you go deeper into the day and become mentally fatigued, it often becomes more difficult for you to use this strategy correctly and adjust your reaction. It's easy to think that you would build in your success earlier in the day, but that doesn't always happen. Building the mental strength to control and correct your emotional reactions is a lot like weightlifting. Start with the amount of weight that you can lift and steadily increase it. Rather than just expecting yourself to continue trading at a time when you typically would quit, push yourself to avoid a big mistake for just 5 or 10 more minutes. Then as you get mentally stronger, add another 5 to 10 minutes. Sure, 5 to 10 minutes can seem insignificant, but so too with the amount of weight you'd be able to lift on your first trip to the gym. Start small, and then push yourself to maintain control longer and longer. Eventually, the severity of the patterning that's triggered will decrease in intensity, an indication that you're moving towards resolution, and you'll be able to avoid severe reactions for hours, even during some very difficult times. Use quitting as a short-term strategy. As long as you have a clear plan to resolve your mental game problems, quitting can be a viable short-term strategy while you work towards resolution. There isn't a hard or fast rule to determine when the best time is to quit. Sometimes you need to push yourself, while other times you need to quit to avoid a big step back, mentally or emotionally. Part of this skill is knowing when a mental game issue is too severe to carry on, and you need to take a break or quit. Of course, sometimes you don't know the limits of your capacity until you hit a brick wall. My advice is to err on the side of caution in the short term. By following the system laid out in this book, your capacity will increase over time, provided that you don't continually push yourself too far beyond the point of failure. Like someone in physical therapy rehabbing an injury, if you overdo it, you risk getting re-injured. Build a productive routine. Once you have identified the problem to resolve, you need to work the problem with a consistent routine and rigorous focus. When you have a routine that prepares you properly, you're more likely to execute well and make improvements. On the other hand, if you fail, you're more likely to understand why and to learn from it, which ultimately leads to progress in the future. Essentially, you create a cycle of improvement that allows you to make the most of each trading session. Take time for a warm-up. The value of a warm-up is widely understood within sports and most areas of performance. While the idea of warming up before playing poker was surprisingly novel when I first entered the poker world, that's not the case in trading. What may be novel, however, is the idea of a warm-up or pre-market routine being used not only to put you in the right state of mind for trading, but to better prepare you to correct the range of problems you're likely to face. In practical terms, this means your warm-up should include reviewing the maps you have created for each problem area. This increases the likelihood that you spot the real-time signals of a problem. You should also reread the mental hand history and injecting logic statements to strengthen your understanding of the cause and correction of the problems that you'll face. You might think back to a few recent scenarios that were troublesome. Envision yourself going through the process of seeing the signals of the problem, taking a deep breath or standing up, and then using injecting logic and a strategic reminder. Basically, you're mentally rehearsing the actions that you'll take to control or correct your problems. If all your materials are already prepared, the whole process takes 3 to 5 minutes. Be sure to focus intently and bring a sense of priority. Never just go through the motions. Take time for a cool down. Just like the warm-up is an implicit part of most performance arenas, especially for athletes, cooling down is as well. For athletes, it tends to be more focused on physical recovery, like getting treatment, icing down muscles, etc., to help the body heal and recover. The cool down is essentially preparation to be able to do it all again tomorrow. As a trader, your cool down may include logging trades into your journal, analyzing them, and checking P&L. But you also need to focus on recovery from a mental and emotional standpoint. For example, add details to your map, write and vent about your emotions to prevent accumulation, and analyze your progress. Your mind has captured so much data, including the emotions, thoughts, and actions that surround each problem. If you're diligent about capturing those details and working through them, you'll find that the 5 to 15 minutes you spend will be incredibly valuable the following day. Since this time is so valuable, here are a few suggestions for adjustments you can make to your cooldown depending on the type of day you had. On a day where your emotions stay relatively stable, where problems may have popped up but you handled them with relative ease, it's unlikely that there will be many new things to note. Instead, reinforce your progress by thinking or writing about what improved. Don't just focus on the negatives. Emphasize instances where your attempts to correct anger, for example, were successful, especially if it took a lot of mental effort. On a day when emotions are high, vent your emotions by writing them down, and then either reread an existing mental hand history on this topic or complete a new one. This will help you to prevent accumulated emotions and reinforce the correction. You don't need to start immediately after the trading day is over, but I strongly recommend you start within 30 minutes, while the ideas are fresh in your mind and the emotion is raw. That's the good stuff. Not only do you not want to lose those critical details, but this is also a prime opportunity to generate new insights. On a day when emotions are super high, you probably want to just go blow off steam, wallow in self-pity, or enjoy the rush of a euphoric day. One of the last things you want to do is sit down and write. But your goals are recovery and getting in good shape for the next day. The best thing you can do is dump as many thoughts down as you can. In part, because when your problems are the biggest, you get a better glimpse into the root of the problem. You don't have to do a mental hand history, just be a detective and grab the data. If you just rush off, you might lose details that could be critical to solving the problem. Take time to work the problem. You can't show up right before a trading session and map your pattern, complete a mental hand history, define injecting logic statements, or finish an A to C game analysis. Before a session, you only have time to review or revise existing material, not generate them from scratch. To work efficiently towards resolution, these are tools that need to be worked on at the times when you'd normally be doing research, learning new concepts, or other things to improve your trading. I realize that I'm adding more responsibilities, and there's only so much time in the day. Perhaps now that you're working aggressively on your mental game, you'll prioritize this work. Then as the materials are created, and you have a strong overall strategy, you can reduce the time spent to an amount that you can consistently maintain. In general, you want to be sure you continually work the problems, even if that just means reviewing or updating existing materials. Evaluate progress. If you want to reach resolution as efficiently as possible, you need to know whether you're making progress or not. That's not so simple, because of both the unpredictable nature of trading and the complexities of evaluating your own mental and emotional state. A common mistake I see traders make is relying on emotions as the measuring stick for progress. Even when you're making progress, you may not feel the difference emotionally. For example, you might feel just as fearful entering a trade today as you did several months ago. But if you look closely, you notice that your thoughts are less pessimistic, you hesitate less, and you no longer open a 1-minute chart with your eyes glued to every tick. Those indications of progress aren't evident from your emotions. You have to look at changes to other signals on your map. Identifying whether or not you've made progress is critical. You could incorrectly think nothing has improved when it has, and lose confidence or motivation in a strategy that's actually working. Or if you aren't improving, you need to know this, so you can figure out what's not working. The following are some general indications your mental game is improving. Are you increasingly able to recognize your pattern, including being able to spot signals before you reach your threshold? While you may not have established the ability to control or correct your emotions in real time yet, you're better at seeing what's happening. While this may seem insignificant, increased recognition is a critical first step. The remainder of the real-time strategy doesn't work without it. The next big marker of progress is being able to control or correct your emotions. Look for those moments when greed, tilt, or fear is about to cause a mistake, but you catch yourself and use injecting logic. It's not so much that you don't react, as you don't let the reaction carry you away in the manner it used to. That, in turn, reduces your emotions and improves your decision-making and execution. While you may have to battle for that progress, you win the battle more often. At first, your mental and emotional state may improve by only a fraction of a %. That's still something to build on, because you're simultaneously training the long-term solution. Over time, the correction becomes more potent, cutting through the emotional reaction faster. so you can minimize the damage and recover more quickly. You also don't need to take bigger chunks of time off during the trading day. Eventually, you will clearly have less emotion to battle, and you'll see that resolution has begun. Resolution isn't a light switch, especially with intense emotions. Think of it more like a volume knob that you dial down. For example, you still feel that immediate reflex of greed or the impulse to revenge trade, but apples to apples, it's 10% less intense. As progress continues and you resolve more of the problem, you automatically generate less and less emotion. That means your emotions are naturally more stable, and whatever fear, anger, or overconfidence remains is much easier to chop through. Eventually, the triggers no longer produce emotion and the problem is resolved. The biggest problem in recognizing resolution is that you won't know when you've crossed the finish line. It's not like running a race where the end is marked, but there are clues that indicate you've arrived. Here are some signals of resolution. You remain competent, even under pressure or extreme fatigue. To see how far you've come, compare your current worst to your prior worst, and see how much your decision-making process has improved. In your B game, the impulse to make mistakes caused by emotion disappears. There's less interference or noise in your B game. It feels qualitatively different. At times when your emotional reactions were previously intense, they're now less severe, automatically, and without conscious effort. You have increased mental clarity or bandwidth to improve your A game. Mental space has been freed up through back-end mastery, and that makes you more creative, willing to innovate, or open to learning new things. You have a greater desire to tackle projects or concepts that you had previously been introduced to, but didn't feel like you were able to begin. Another indication of resolution is evolution in your mental game. As the back end of your range progresses, your C game changes, either with previous problems becoming smaller versions of themselves or entirely new ones popping up. Perhaps you got rid of your issues with low confidence, but you swung too far in the other direction, and now at times become overconfident. Or improvements in your perfectionism lowered the fear of loss, and you began to enter more trades, but now you tilt from losing. You must see these new problems as evidence of progress. You graduated to a new C game, and that means you have the potential to reach an even greater A game. Perhaps you've already seen it. Or, despite your best efforts, unfortunately your mental game hasn't improved. You've worked hard using the system, but you haven't been able to sustain a change of any significance. In the next and final chapter, you'll be able to troubleshoot common causes that stall progress or create significant setbacks and learn what to do about them. Chapter 10. Troubleshooting a lack of progress. The most important thing to do if you find yourself in a hole is to stop digging. Warren Buffett. At the end of the last chapter, I talked about evaluating your progress. But what if you're not making progress? While there's too much diversity to troubleshoot all of the potential causes of a lack of progress, in this chapter we'll drill into 6 common ones. Difficulty recognizing your pattern. Your reactions come swiftly and arise seemingly out of nowhere. Problems continue to happen, but you can't spot how they start. You see the evidence in the aftermath of mistakes and losses, but you can't recognize the preceding signals that are critical to stopping your emotions from escalating or keeping your discipline from breaking down. In my experience, there are 2 common scenarios why you can't recognize your pattern. In scenario 1, you haven't really done the work. Be honest with yourself. Did you just read through the book, expecting the changes to come through osmosis? Or did you actually put in the time and effort to map your patterns as I suggested? If you didn't do the work, you need to. There's no other way around it. To make it easier, try talking with a mentor or another trader. Maybe in the early stages, you need someone to brainstorm with and bounce ideas off. In scenario 2, you did the work, but you're so skilled at suppressing your emotional issues day to day that you didn't find anything. Then, out of nowhere, you have these big blow-up days, and you can't recognize what prompts them. The key here is to become more attuned to the signals of suppression. What are the actions you take or the thoughts you have that you use to manage your emotions or keep them at bay? These are currently your automatic responses to the presence of greed, fear, or anger. For example, you might immediately talk with another trader about what happened, or you might be hyperlogical in your assertions that a loss didn't affect you. Those responses are the signals of a low-level problem, and you can begin mapping from there. You should also complete a deep dive after your next blowout day to try to get to the root of the issue. Use the different sections of the book to complete a mental hand history, and then take those ideas and bring them to your day-to-day attempts to recognize their presence. For example, let's say you figure out that you have an illusion of control. That's what causes the mixture of greed and overconfidence that's part of the blow-up. Now look day to day and ask yourself, how am I over-controlling? For example, you're overly focused on keeping your R factor high, and you've set your stops too tight because you think price will move in your favor. These become additional signs where greed or fear can begin, and you've got a starting point for injecting logic and beginning to correct the illusion of control. Things get worse before they get better. Ideally, you'll take the lessons and tools you've gained from this book, put them into action, and immediately make progress. But sometimes, for several reasons, the opposite can happen and problems worsen. First off, once you start looking more closely, you might find the problems in your mental game are actually worse or more complex than you had originally thought. Essentially, you've ripped off the bandage to get a look at the injury, and it's not pretty. What you thought was your C game wasn't. It's more like you have an F game. But while the truth can hurt, at least you now know what you're dealing with and can plan how to proceed. Being more aware of your emotions can also feel like you're taking steps backwards. Greed, fear, or tilt can feel more intense when you pay closer attention to them. These are not actual steps back. Rather, you're becoming more aware of what had previously been ignored. All of the new information about your mental game can be overwhelming. You've learned a lot of new theories about learning and emotion, found out about numerous problems you might face, and discovered their causes and corrections, all while trying to understand the details of your problems. There's a lot more that you're aware of now, so you're figuratively tripping over all this new information while you work towards developing greater competence. This isn't uncommon, especially if you read the book all in one pass. If this sounds familiar, focus on the low-hanging fruit that will give you some easy wins and a chance to turn what you learned into a simple strategy you can build on. This way you'll find some solid ground to stand on, rather than trying to do too much all at once. Otherwise, you'll feel like you're treading in quicksand, where everything you do makes you sink deeper. If you have trouble prioritizing, consider this guideline. Try something, and if you're not making progress within 2 weeks, reevaluate and select something else. At times, getting started is the only way to gather the info you need. Some things you can't learn from the sidelines. Finally, another reason you might have gotten off on the wrong foot is the variance in the market. Sometimes the timing as to when you start to implement these new mental game strategies coincides with the shift in the market, or a streak of losses that is out of your hands. Don't overreact to circumstances you can't control. Instead, think of the opportunity another way. Getting beaten up early allows you to get to the true bottom of your range that much faster. Then as market conditions or results turn in your favor, you're apt to have fewer surprises down the road. Sure, it would be great to see progress immediately, but if the opposite happens, take advantage of the opportunity it provides. Burnout. Burnout is common among traders. The markets don't care about your need to take time off. And if you're trading markets that are open 24/7, it feels as though you never get a break. In the back of your mind are constant thoughts and awareness about trading. There's also high demand for precision with every decision, which makes you more like an athlete than an employee in a secure 9-to-5 job. Plus, when you're trading your own money, in a drawdown, or struggling to get a feel for the market, the constant stress can burn you out. As it relates to your mental game, burnout intensifies your problems and limits your ability to improve them, even if you have correctly identified the root cause. Your mind is in a weakened state, so you lack the strength, clarity, and poise to execute your strategy and fight for progress. Emotional volatility is higher, and emotions accumulate at a faster rate, which means you have more emotion to handle and less mental strength or willpower to battle it. The correction for burnout is simple: rest. There's no other way around it. The problem is that the kind of rest that you need to recover from burnout is costly. You don't make money when your trading business is closed. And for some of you, it makes sense to push yourself through these times, like an injured athlete in the playoffs who has to stick it out because giving up isn't an option. There comes a point, however, where burnout is too significant. Much like the classifications for physical burns to the skin, there are different levels of severity to burnout. The more severe it is, the worse your decisions become, and the longer it takes you to recover. To prevent a severe burnout, you need to figure out the 1 or 2 signs that indicate you're nearing that point. The signs could be emotional. You no longer have any control over tilt or greed. Or it could be evident in your discipline. Maybe you can't follow your own rules to make proper entries and exits. You might notice a distinct change in your motivation. For example, mild burnout is signaled by a lack of interest in completing thorough research. On the other hand, not wanting to trade at all indicates severe burnout. The best time to research your signs of burnout and identify the key factors is after each occurrence of burnout. Think of it like mapping any other problem I've described in this book. Take good notes, and the next time around, use what you found to spot the early indicators of burnout. Then you can take steps just prior to reaching that point. For example, if you find that 15 days of break-even trading during an intense market is your limit, then after day 10, take extra steps to help you reset daily. Prioritize your cooldown, diet, exercise, and sleep. Be social, engage in your hobbies. Read for enjoyment and not development. Or do something fun and not overly mentally stimulating. This will help not only delay the onset of burnout, but possibly prevent it entirely. You stay right at the edge without quite going over it. Bloated brain. Previously, I discussed how focus is your tool to gather the data you need to make decisions. But when you gather too much data, a subtle problem emerges that few traders know about, one that I call bloated brain. Even though it's not commonly identified, I do believe it's commonly experienced, as I've seen through the years of working directly with clients. Think about those trading days where you were intensely focused for so long that you stopped being able to properly analyze the market and missed opportunities or forced poor setups. Or how about the times when you were researching, studying new methods, or backtesting for large chunks of time and reached a point where your brain just shut off? You couldn't focus any longer, and new information no longer made any sense. At those times, your mind is so full of data that you don't have the room to hold any more. You're like a soaked sponge, unable to absorb any more water. You have a hard time concentrating, miss key information, and feel mentally exhausted, like your head is in a fog. You most likely assume that you're just tired, and that it's a natural consequence of the long day or the intensive focus of researching and learning. And to some degree, that's true. But fatigue doesn't tell the full story. The other side of the story is that your brain is full of data. The deluge of information crammed into it creates the drop in clarity, thinking, and execution during the trading day, and can make it hard to segregate trading from your life. You try to have dinner with your family, watch a ball game with a friend, or do whatever you do to relax, but your mind won't stop. You're there, but not totally there. Thoughts continue to pop up. Then when you're tired and ready to go off to bed, your mind is active and won't settle. You replay mistakes and missed opportunities, reconsider the exit strategy on a profitable position, or mull over new research that you were thinking about earlier. This can go on for hours. Other times you fall asleep right away, but wake up early to thoughts about trades or research. In some ways, you might not consider it a problem. You like the constant focus and innovative thoughts, and you view the loss of sleep or lack of presence with family and friends as a cost of this business. But you also know what it feels like when your mind is sharp, fresh, energized, and focused, and you don't have it as often as in the past. When there's too much data being absorbed, it can carry over day to day. Accumulated data is very much like accumulated emotion, and in a subtle way, it can limit your ability to think clearly and process information the following day. When you're driven to optimize your performance and learning, a cluttered mind is a hidden danger. The good news is that it's fairly easy to address by adding simple habits into your daily routine. The brain has a natural process for digesting information and converting it into valuable knowledge, just as the body's digestive system extracts nutrients from food. You can make that process more efficient. During the trading day, or during long periods of researching or studying, take breaks before your brain shuts off. Taking just a few minutes, where you stop consuming new data, can give your brain an opportunity to digest more of what you've absorbed. In that time, take some notes, go for a walk, or meditate. You may not feel like you're completely reset, but in some ways that doesn't matter. You're looking to just delay the drop-off in your performance until the end of the trading day or duration of research, so you can maximize the effectiveness of your working time. Then, after trading or researching, help your brain digest the data by writing or talking and then taking notes, whichever you prefer. You don't even have to review what you write to experience a benefit. The mental clarity you achieve from getting the data out of your head is valuable on its own. However, I recommend that you review a few of the key takeaways from your writing as part of your warm-up before the next time you trade. This creates a cycle where you regularly focus on improving specific parts of your tactical and mental game, before, during, and after you trade. That kind of repetition is key to accelerating improvement. Writing is also a good tool when you can't sleep. Rather than trying to go to sleep when your mind is full, write about what's in your head. Note down details of a difficult decision, mistakes that you made, or modifications to your strategy. Do it until you have nothing left to write about, or up to 30 minutes, and then try to go to sleep. You may not fall asleep without any thoughts the first time you try it, but with practice you'll train your mind and eventually fall asleep faster. Clients who follow this advice tell me that by regularly dumping out the data that accumulates in their mind, they feel mentally refreshed at times when they previously assumed they were tired. They also can better separate trading from their lives and go on with their day without the same need to mentally reset by blowing off steam, drinking, or an intense workout. They sleep better, and they have more mental clarity while trading. Try it yourself for 7 to 10 days and see what you find. The space in your mind is valuable real estate. Keep it clear, and you'll see an improvement in your execution. When life bleeds into trading. Sometimes your mind is consumed by emotional and energy-draining personal concerns that affect your ability to progress. For example, an illness in the family, conflict with your significant other, or major decisions or tasks, such as moving or renovating a home, can be all-consuming. When life bleeds into your day, it can take away from the enjoyment, the challenge, and the curiosity you ordinarily bring to trading. Execution and performance drop, and suddenly the weight of the outside factors seems even greater because you're losing money too. Not only does trading suffer, but you go right from the trading day back to these personal dealings. You don't get a break, and things can quickly spiral out of control. The goal is to protect your progress and execution by keeping all the personal thoughts, tasks, and emotions out of trading. Essentially, you create a bubble around trading that keeps your life out of it. In addition, keeping your personal life separate gives you a much-needed break and allows you to attend to the personal stuff with a clearer mind. Trading becomes like a mini vacation from your personal life. Here are the steps to create a bubble around your trading. Step 1. An hour before the trading day starts, write down everything on your mind on that particular topic. It could be how you feel, specific thoughts, a practical to-do list, or things you want to say to people. Spend up to 20 minutes doing this. Step 2. After completing that initial writing task, draw a mental line in the sand where from that moment until the end of the trading day, you don't allow yourself to think about your personal concerns. Step 3. Now it's around 40 minutes before the trading day. You should use the time as you would normally. The time isn't arbitrary. Writing up to 20 minutes allows you to release the thoughts without being consumed. It also builds in a buffer of time. If you have additional thoughts about that personal stuff that you can't get out of your head, you have a chance to capture them and reaffirm the idea that you're not thinking about this until the end of the trading day. And then, whenever you have momentary thoughts, use the injecting logic of, not now. And if they don't go away, take a few minutes to write them down and reaffirm the bubble. Of course, sometimes you have practical things that must be attended to during the trading day. For example, 11 a.m. is the only time the doctor or contractor can talk. Once these tasks have been concluded, repeat step 3 and get back into the bubble. When trading exposes personal problems. When you have unresolved issues in your personal life, even ones you didn't know were a problem, they can spill out into trading. Having these issues appear in trading can often be confusing because you don't experience anything like them outside of trading. In the rest of your life, you're confident, decisive, and emotionally balanced. It doesn't seem to make sense why these emotions come out in trading. Trading is a unique test that can bring out your deepest fears, unresolved rage, and personal insecurities. These problems directly affect your execution and profitability, compel you to take on too much risk, lock up profit prematurely, or chase losses, but they have nothing to do with trading. Rather, investing so much of your time, energy, money, future, confidence, and identity into trading eventually just brings out these deeper personal issues. Some of you have a need for trades to work out to confirm a sense of personal competence, purpose, and success. When you fail in trading, you feel like a failure in life. Or maybe you get so angry when you get stopped out that you're compelled to immediately re-enter. Perhaps as a kid you hated losing and were relentless until you won. Maybe you can't seem to make a move, even when you want to. Maybe your parents expected perfection and overreacted to any mistake you made. Now, fear of a mistake keeps you on the sidelines, and you get pissed off when you miss entries. Either way, you can't win. The good news is that once you get to the root of the problem, you have a chance to cross-train and improve both your personal life and trading at the same time. Digging through personal issues can be tough. If you want to try tackling them on your own, use the mental hand history as your tool to organize your work. Look closely at the cause of your trading problems and identify the personal equivalent. Then use what you find as step 1 and complete the remaining 4 steps. If the problems you have are particularly severe, consider working with a therapist. To give you an example of what this can look like, here's a story about my client Will. After retiring from senior level roles in corporate America, Will took up trading as a part-time occupation that would hopefully add to his retirement income. In his previous career, Will was known as an even-keeled guy who got things done. But when he began trading, he tapped into a vein of anger he didn't realize existed. Trading stocks and equities, Will's general goal was to trade for an hour or 2 in the morning, freeing up the rest of the day for other pursuits. The problem was, he would make some money, then take a loss, and end up giving it all back in a death spiral. He would get angrier and angrier until he was in a full-blown rage. He would scream, cuss, break things, and literally fling himself to the floor and pound on it in frustration. He had no control over his reactions, and had turned into a person he didn't recognize. Will described days when he'd be yelling, "Kill the trade!" but feeling like his arms were frozen. He couldn't get out. He actually videotaped himself so he could watch what it was like and was astounded. "It was like aliens had taken over my body," he said. "I watched myself acting like a 5-year-old. I was throwing a temper tantrum." Will hadn't experienced this level of anger before, in either his personal life or his former career, which made the problem harder to comprehend. It was at the time inexplicable to him. Will began extensive research. He read books and applied their advice. He produced volumes of material trying to understand and address his anger. Will was one of the most meticulous clients I've had in my entire career when it came to the amount of content he produced by journaling, mapping his patterns, and working through his problems. As we dug through that material, we soon realized that he had problems with an illusion of control, perfectionism, and a fear of failure, all of which were rooted in childhood trauma he needed to come to terms with. As Will worked through the personal trauma outside of trading, it was important for him to recognize, while he was trading, that his emotions were related to those old issues. The urge to, for example, add to a loser, oversize trades, or avoid setting protective stops was a signal that his personal problems were seeping into his trading. In those moments, Will began injecting logic that incorporated corrections that he had found on the personal side. That allowed him for the first time to stabilize his emotions enough to take losses and avoid a major blow-up. As we continued to work through each step of my system, using many of the strategies outlined in the desperation section of this book to establish clean layers of control, catalog his accomplishments to date, and identify the roots of his technical errors using the mental hand history, over time, Will's anger lessened, and that allowed him to become more aware of when it started so he could quickly correct it. He focused on the probabilistic nature of trading and got himself more comfortable with the overall risk and the role of variance. He learned to remind himself that if price didn't move in the direction he wanted, he wasn't responsible for that result unless he held onto it against his plan. Eventually, Will could make a mistake and think, "Well, that was a boneheaded move," and quickly reset, rather than pounding on the table and losing control. I caught up with Will after not talking for a couple years. He told me that today, about 98% of that initial anger is gone. He no longer breaks keyboards in half, throws the computer mouse across the room, or has tantrums, although he admits he still cusses a bit. As we caught up, Will wondered why the childhood trauma had come out in trading and not before. I explained his situation to him with an analogy related to war. It was as if Will had experienced war crimes during deployment and couldn't process them until he was safe at home. In his case, the crimes were trauma from his childhood, and being retired with a firm financial future felt like being home safe. Trading just happened to be what he was doing when the layers of trauma started to emerge, and due to the intense nature of trading, those wounds were ripped open and laid bare. Having healed the majority of his personal trauma and the trading mistakes that were caused by it, the problems Will deals with now are the normal ones covered in this book. He's graduated. The key for him going forward is to remember that the system worked and to use it again on the more typical performance problems so he can continue to improve. As you've no doubt realized by now, continuing to improve is a core theme of the mental game. Final thoughts. In any given moment, we have two options: to step forward into growth or step back into safety. Abraham Maslow. You began reading this book knowing something, or many somethings, were getting between you and trading at a level you knew was possible. No doubt you'd already explored your technical skills and eventually realized the stumbling blocks in your way had to do with your mental game, and that's why you turned to the system I offer in this book. After diving deep into the system and learning about your performance flaws at the root of your problems, you're armed with the strategy and tools to correct them. The system works if you do the work. To make progress, take what you have read in these pages and start applying it every day. Use the descriptions and accounts from other traders to help you uncover your own patterns and the unique ways your performance flaws emerge. Map your patterns and develop an A to C game analysis. Complete mental hand histories. Create injecting logic statements using your own words, and a strategic reminder that applies best to your style of trading. Also incorporate other resources, both from within trading and outside of it, that resonate with you, such as books, videos, quotes, or interviews. There are many valuable sources of information out there that you can use within the system to help you achieve resolution. Be ruthless in identifying and correcting the many mistakes you make as you go, but find moments to have fun with the process. Like the market, there will be ups and downs. Some days you'll reach new highs, and other days you'll struggle. Embrace that reality and just keep doing the work. Permanently correcting or resolving your performance flaws, biases, illusions, or wishes doesn't come quickly. You need a lot of repetition. Most often, you also need a lot of repetition in a lot of different situations. Keep at it. Continue to use this book as a resource along the way. There's too much to absorb and apply in just one pass. When your mental game progresses beyond the problems that originally brought you here, apply the system to your new problems. Remember, the system isn't meant for you to use once and set aside. Growth is a constant for those who want it. If you continue to apply the techniques, tactics, and insights, you'll continue to make progress and reap more benefits. You'll be able to keep moving your inchworm forward and improve your A, B, and C games. The time to start is now. Literally right now. Even if that means taking just 1 minute to begin moving forward. No more excuses. Get to work. It's time to turn your potential as a trader into a reality. If you'd like to stay up on my latest blogs, podcasts, or projects, or to access downloadable worksheets that can, for example, help you map your problems, complete an A to C game analysis, or fill out a mental hand history, go to jaredtendler.com. Acknowledgements. I'm not a natural writer, so I relied heavily on others for help. I'm deeply appreciative to the many people who helped make this book happen. I could not have completed it on my own. First and foremost, my writing partner, Beth Kopczynski. Thank you for your incredible expertise and unwavering dedication to this project. Even though the finish line took longer to reach than expected, you were an incredible partner from beginning to end. Your questions, insights, and perspectives helped me to see my material in a new light, and I'm forever grateful. Marcy McDonald, my amazing editor, thank you for your vision and guidance. You delivered on your promise and brought the book to another level. To all the clients I've worked with over the years, thank you for helping me to better understand the nuances of trading and the demands of your profession. I particularly want to thank the traders who lent their stories and examples to this book. Alex Raguse, Brendan, Brian Heffernan, Carlos Espinoza, Chris Duhansey, David Lombard, Franz Geller, Giacomo, Goro Kanehara, Gurdeep Gossel, Joseph Aboud, Max Sidney, Michael Whalen, Nick Winton, Roderick, Vishal Nathu, Vlad Bricken, and Will Rainey. Your voices help bring the book to life, and for that I'm greatly appreciative. I also want to thank my family and friends for your support and encouragement, especially my wife Corey and daughter Teddy. 2020 was a challenging year, but you too made it possible for me to complete this book and enjoy the process. No small feat. Thank you for giving me the space to focus on it. I'm so lucky to have you two in my corner cheering me on. This has been The Mental Game of Trading, a system for solving problems with greed, fear, anger, confidence, and discipline. Written by Jared Tendler. Narrated by Jared Tendler. Copyright 2021, Jared Tendler, LLC.
Hope you enjoyed and found inspiration in the mental game of trading. This book provides valuable insights into mastering the psychological aspects of trading, helping you to make more informed and less emotionally driven decisions. If you found the content useful and enriching, please like and subscribe.